Fed is done. We're moving from a rate hike cycle to a rate cutting cycle.
Cuts would suggest that you see continued economic softening.
The Fed's going to ease. They're trying to get that soft landing. Until we see data that it's not working, it's risk on.
The stronger and more resilient economic activity is, the more cautious I think they're going to be on the inflation front.
Overall, inflation is on the right path, and they know it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The bullishness is absolutely overwhelming. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market a little softer this morning on S&P 500 futures. The S&P closing yesterday just short of all-time highs. Here's some of the bullishness for you, just a flavour of it. Mike Wilson, Morgan Stanley. Equities appear to have the green light to ramp higher. Stuart Kaiser over at Citi, positive, with the Fed extending the window for equity upside into 2024. Lisa, where did all the bears go?
They disappeared. The latest Bank of America Global Fund Manager survey showing that investors are feeling the best that they've felt since January 2022. Their cash allocations are falling to near two-year lows. All of this just shows, okay, people are throwing the towel in, saying, let's go. So now what? How fragile is this rally heading into the next year?
A Fed speaker scrambling, speeches, interviews all over the place. This in the Wall Street Journal from the San Francisco Fed President, Mary Daly. San Francisco Fed will get a vote on the FOMC next year. The conversation on the Fed is changing. We will still be quite restrictive even if we cut rates 3 times next year. And how about this for a shift, Lisa? We have to be forward-looking and make sure that we don't give people price stability, but take away jobs. That is a monster change from where this Fed was in August a couple of years ago.
This is implicitly saying the balance of risks is now not only evenly split, but they are more concerned about the possibility for prolonged job losses that are going to be hard to get back. You are absolutely right. To me, I thought that the Mary Daly comments were really notable in how much they shifted away from the inflation concerns, more toward preserving economic strength.
Remember that Jackson Hole speech, 8 minutes, down the barrel of the camera, pain is coming, and now all of a sudden going into 2024, how about those jobs? We need to protect them. That's a big shift.
You raised a point also in the past couple of days. How much is this Fed Chair Powell being seduced by the idea of a soft landing and embracing it before we're fully there? And that's what we heard from Bill Dudley yesterday, this fear that we could see some kind of reignition of inflation and that they will not be able to tame it. They won't be able to kill it. And I do think about some of the supply chain disruptions we've seen recently, and I think about the fact that people are getting more optimistic about buying homes and buying goods and all of these things. And what is the counter to that in terms of economic growth and inflation?
The shipping in the Red Sea grinding to a halt, seemingly. We'll have more on that story throughout the hour on this programme. We also need to talk about the changes potentially at central banks elsewhere. So we've got the Bank of Canada governor speaking to our colleagues up in Canada, signalling that maybe rate cuts are coming in 2024. Hearing from the Bank of France governor that maybe rate cuts are also coming in 2024. And if you were looking for a change from our friends in Tokyo at the Bank of Japan, keep looking, because, Lisa, we got absolutely nothing from that meeting going into year-end.
Nothing in terms of a decision and nothing in terms of guidance. UADA said there isn't much likelihood of us suddenly announcing that we'll raise rates a month in advance. Basically, we don't do forward-looking guidance. We don't give you anything. And if you want to know when we're going to, start moving away from negative rates, well, you're going to have to keep guessing. And this raises a question. Do they want a stronger yen, or do they want a weaker yen? Are they concerned about trying to get ahead of the Fed cutting rates because they're worried about things strengthening too quickly? I mean, really, what is sort of the calculus that they've got here?
I don't know what they want, but I can tell you what they're getting. They're getting a much weaker Japanese yen this morning. Dollar yen gapping higher by 1.5%, 144 approaching 145 on that currency pair. Here are the scores elsewhere in the equity market on the S&P 500. No drama, pulling back just a touch. We're down by a couple of tenths of 1% to positive a tenth of 1% on the S&P 500. Yields are lower by a couple of basis points. Lisa, on the 10-year, 390.51. All
right, 8:30 a.m. we get U.S. building permits for November and U.S. housing starts. And this comes at a time where we've seen mortgage rates absolutely plunge, more than a percentage point from the all-time highs of more than 8%. This, to me, is the reason why I find it compelling that, A, Fed Chair Powell didn't push back against the market activity, but also the fact that could this reignite some of the activity in housing that is added to the disinflationary action that we've seen. Today, Fed speak, all the pushback includes Richmond Fed President Tom Barkin at 9:30 a.m., Atlanta Fed President Raphael Bostic at 12:30 p.m. and 6 p.m., Chicago Fed President Austin Goolsbee, who yesterday came out and said, everybody just calm down. I don't understand what markets are doing. Didn't he do the same thing about 2 months earlier to try to walk things back?
I have to admit, I felt like that certain Fed officials were gaslighting us yesterday. I really did. I went through the comments from President Goolsbee. I thought there seemed to be some confusion about how the FOMC even works. We don't debate specific policies speculatively about the future. Every time I've heard from them over the last few days, I just want to get that piece of sound from Chairman Powell in that news conference last Wednesday and just replay it. Are you telling me that I didn't hear what he told us, that we all heard, which is that they are contemplating the appropriate time to reduce interest rates, and that could be next year, which was ultimately what we were told in the news conference?
Which really left me thinking a lot about this last night. What if Fed Chair Powell actually wanted to send the message that you can ease financial conditions because he was worried about weakness in his on-operation preserve jobs? We could talk about that more coming up, but I think that you're right. There is an obvious dissonance here. And is this some sort of disagreement on the FOMC, or is this something else? And after market FedEx earnings come out, just want to point out these shares are up about 66% so far this year, 63% now. And this really comes as they gain market share from UPS after some of the union labor talks, as well as some other issues with shippers. Very curious to hear the forward-looking comments as well, given their read on the economy.
Jason Trennert joins us now, Chairman of Strategas Research Partners. Jason, I'll go straight to the quote. Let's just go straight to it. Chairman Powell, Wednesday, in the news conference, the question of when it will become appropriate to begin dialing back the amount of policy restraint in place, clearly a topic of discussion now in the world, and also a discussion for us at our meeting today. Jason, we all heard it. What on earth is everyone else talking about?
I don't know. And you asked the question, where did all the bears go? And I think we know. The Fed shot them, for the last really 2.5 years, which I think was very appropriate. Chairman Powell talked about avoiding the stop-and-go monetary policies of the 70s. And all of a sudden, we're now talking about preemptively easing. And that leads you to maybe three conclusions. One, they're seeing something, as Lisa mentioned, maybe they're seeing something we're not. I think that's unlikely, mainly because they rarely see things that we don't see. They rarely are better at forecasting than we are. The second is that the Fed has become politicized, which I'm not sure is fair. But certainly among our clients, there is a growing sense that that's the case. And the third possibility is simply institutional arrogance, that the fine tuning is really possible when you're talking about economic systems this large. So I'm kind of going with the third. It doesn't make me feel any better, but I also think that as one of the other guests, I think in the intro talked about, until this changes, it's risk on. I think that's clear.
Equities up again this morning by 0.1%. Can we talk about the risks of institutional arrogance then, Jason? Your view, certainly not mine, of course. What are the odds of a second wave of inflation next year?
Well, my colleague Don Rissmiller, who's our chief economist at Strategas, looked at over 30 countries over the last 130 years. And one of the things he found was that once you breach 6% to the upside, in about 9 of 10 times, you have a second wave of inflation, an echo wave. And that is partly because of the way contracts are written, the way inflationary expectations get into the system. And I certainly would think that it's certainly not impossible this time. I think we have to remember that the Fed increased the size of the balance sheet from $4 trillion to $9 trillion. It's now a little less than $8 trillion, but that's an awful lot of money that was created in a short period of time. The level of M2 is 40% higher. So it is, and we're running, I would say, incidentally, we're running budget deficits of 6% of GDP at full employment. So, the possibility of having another wave of inflation to me is not impossible. I know there's a lot of chest thumping now and a lot of spiking the ball. Perhaps you'll see some Fed officials try to walk that back today. But I'm somewhat concerned. We have to play the ball as it lies as investors. But by the same token, I think they're counting on the fact that there won't be another wave, and I'm not so sure.
So how much can you push back against the recent wave of, I don't know if you can call it euphoria, but signaling the all clear? How do you become a bear if the Fed's going to shoot them all?
Yeah, I think, at least it's a great question, and I think the answer is you really can't. I think you have to incorporate liquidity you always have to, but I think more now more than ever. I'd also say the Treasury Department is certainly playing an active role in terms of their refunding in the bills market to try to manipulate interest rates as well. And I don't think that sounds overly conspiratorial. I think it's obvious. And so we have to, as investors, you have to incorporate that into your thinking. Next year also is an election year. And my interactions with the Fed have always been so positive in terms of their intentions. I think as an institution, I've always felt that the Fed, more than any other Republican or Democrat administration, is almost always trying to do the right thing. And now there are real questions among our clients as to whether the Fed is playing politics. That may be unfair, but that is certainly the perception out there in the institutional investment community.
So, Jason, if I'm getting this straight, you feel uncomfortable. You think that we could get another wave of inflation, but you can't really lean against this market rally, and you kind of have to lean in, right? So where do you lean in?
I think you have to lean in maybe some more of the cyclical sectors that, aside from tech, and I certainly wouldn't short tech or communications, but they've had big runs. So there may be some other sectors like industrials, like energy, perhaps, where there's decent fundamental cases to be made for strength next year, or at least they're cheaper and they're more cyclical sectors. So those are two sectors that seem to me to be kind of interesting. You may know we've passed some pretty extensive infrastructure bills, and remarkably, so little of that money has actually been spent. It's been appropriated, but it hasn't been spent, and it will be spent next year. Again, an election year, which I think is that final point on it being an election year, I think is looming large. I really do, in a lot of the decisions that are being made, both by the administration and sadly the Fed.
Oh, so you agree that maybe it has been, to some extent, Jason, politicized?
I do, and really it saddens me to say that. And of course, I have no knowledge of this. It's just my own. I'm looking at the what's happening, and it's hard to come to some other conclusion. The arrogance, the institutional arrogance, maybe the better answer, is probably the more correct answer. But certainly there is a perception out there that the Fed is becoming more political ahead of the election year next year. And again, that may be unfair, but I spend all my day talking to institutional investors, and I think there is, I would say, mild shock at the change in tone that we saw from the chairman last week.
A lot of people walked away from that news conference asking some big questions. Jason, thank you, sir. Fantastic to catch up. Enjoy the Christmas period. Jason Trennert there, a Strategas. And just for the record, no bears will be harmed or shot in the making of this programme. Bears are welcome on this programme, Bramo, you know that.
Are they? I've gotten a lot of, different...
You get some pushback.
Well, I get, little cartoons of bears sitting around scratching their heads and looking lost and saying,
any conversation, Bramo, about next year needs to start with a conversation about last year. I was going through the year-ahead price targets on the S&P 500. As of December 12 months ago, looking out 12 months, the average was 4,000 points. By the end of this year, we might fall some 20% short of that. 20%. That's a big miss.
Okay, this is the issue, right? They missed to the downside. Are they going to do that again? Well, we've already gotten to the year-end targets. How much do they have to ratchet that back up?
Just keep pulling it forward and pulling it forward. From New York City this morning, equity futures just about positive. Good morning.
America's commitment to Israel is unwavering, and no individual, group, or state should test our resolve. So in the Red Sea, we're leading a multinational maritime task force to uphold the bedrock principle of freedom of navigation. Iran's support for Houthi attacks on commercial vessels must stop.
That was U.S. Defense Secretary Lloyd Austin speaking in Tel Aviv alongside Israeli President Benjamin Netanyahu, announcing a joint task force to counter attacks from Houthi militants in the Red Sea. Shipping through the Red Sea grinding to a halt. How about this for a statistic this morning? The container shipping firms that have so far paused transits through the region account for 95% of all the transportation capacity deployed through the Suez Canal. Lisa, that according to Clarkson Research Services.
And you can see the commensurate increase in natural gas prices in Europe. You can also see just generally this feeling that there could be some disruption. So here's a question. Can this task force step in quickly enough to really make a difference? Or are we going to see this as sort of the new headwind to the potential of disinflation going forward?
It was Maersk going into the weekend, then it was BP to start this week, and maybe even more to come if there's any left. Let's get to the scores right now on the S&P 500. Equity futures pushing higher. We're talking about 4,800 potentially on the S&P. I'll go back to what I mentioned before the commercial break. We had a median, average target even, of 4,000 points year-end on the S&P, and here we are looking at 4,800. In the bond market, funnily enough, yields are back to where they were on a 10-year to start the year, Lisa. 390.89 on a 10-year this morning. We're down a couple of basis points.
So then this raises this question heading into next year. Are we going to get the expectation for 2023 just a year late, or are we going to get another repeat of what we saw in 2023? It's a valid question because everybody was set up for a recession and then some sort of expansion after that. Now people are expecting, maybe you could get, grow, then slow, or slow, then grow. I mean, basically people are trying to play around with this idea.
Or cities?
It was cities, but then it's like, can you bet on what's going to happen? This expansion, this glorious expansion before you get any kind of recession.
You popularized cities research for them, which is a good thing, Bramo. So on Wall Street, there's exuberance. Down in Washington, D.C., for Democrats, apparently there's mass depression. This coming from Greg Valliere of AGF Investments. A gloomy holiday season for Democrats. It's impossible to exaggerate the mood of despair among Democrats in this town. Greg Valliere joins us right now for more. Greg, let's start there. Just how bad is it?
Yeah. Well, I think the Democrats worry that not only could they lose the White House next fall, they could lose the Senate and the House. The Democrats have narrowly the Senate. So I think that there's a feeling that the Joe Biden job approval numbers are so bad that you still have to think there's an outside chance he could be persuaded to drop out.
Greg, if the election was held today, how bad would the loss be?
It would be significant, by maybe 3 or 4 points. A lot of the key electoral votes states, Michigan, Pennsylvania, Georgia, would go probably to Trump. So yes, of course, the election's 10 months away, and a lot can happen. There are issues that could break in Biden's favor, but on just about every issue, immigration, crime, except abortion, on almost every issue that Biden is not doing well.
So who do you think, Greg, could take over in the Democratic Party and could actually run a viable Democratic presidential campaign?
Well, you hit the nail on the head, Lisa. There's a strong feeling that Kamala Harris lacks the gravitas to take over. I think she's actually underrated. But there obviously would be a strong focus on Gavin Newsom, who has said he wouldn't run. And I think also a strong focus on Gretchen Whitmer in Michigan. I think she would be a sleeper to watch.
At the same time, there's still questions around who the Republican nominee is going to be. Everyone just assumes it's going to be the former President Trump, and yet there was some dissent among Republicans as the former president came out and said immigrants are, quote, poisoning the blood of our country, creating a really awkward setting for them to come up with some sort of border control deal with the Democratic president. How much is the Republican Party moving away from former President Trump?
Not much. I'd say that the majority of people in the party here in Washington refuse to speak out against him. That comment on immigration was straight out of like 1937 Germany. So it's unnerving, but I think the Democrats are still on the defense when it comes to immigration. This is maybe the greatest crisis facing the country right now, and the Biden administration has not done well.
This is the policy challenge going into year-end and to start 2024 as well, Greg. How do we get an agreement there and an agreement to fund two wars, one in Ukraine, another in Gaza?
Yeah, I do think that the need, especially for Ukraine, is so acute that we'll get something, John, but not before they go home. I mean, they may go home in the next day or two. You can't write a bill between now and Christmas. So it will come in January when we also have a big budget fight, as you know. So we go right into a very, very volatile period. I think around the world there has to be some sense that the U.S. is not a reliable partner. You look what's happening in the Red Sea. You almost get the sense that countries may test us because we've shown an inability to act with resolve.
The reluctance to support some of these wars, Greg, is pretty clear in either party. Do you think the reluctance of Republicans to carry on funding the war in Ukraine is bigger than the reluctance of Democrats to provide aid to Israel?
I think that the need for Ukraine is more acute because the Ukrainian army has stalled. And I think Putin feels, fairly or not, that he's now the aggressor. So I think that's probably more important. I would say, though, in both parties, there is a strong sentiment that we have to do something about immigration. We're getting over 10,000 people a day coming into the southern border, and that cannot be sustainable.
Greg, I got to say, your note started with, it's impossible to exaggerate the mood of despair among Democrats. The headline to Punchbowl News' newsletter that came out this morning was January is going to be terrible. What's going on in Washington? I mean, have you ever seen a corollary to this type of dysfunction and lack of action in the face of real necessary decisions?
There's been a lack of leadership, you have to say. We've got a new House Speaker who is not fully tested. You've got an 81-year-old president who seems to be not perhaps on top of a lot of things. And you've got a very disgruntled public right now that still worries about inflation. I don't. I think Biden's done a pretty good job on the economy, but I think the public doesn't agree with me. And there's just everywhere you look, there's a controversial issue. And if there's a wild card that I think could be huge, it is abortion.
Well, Greg, let's talk about what you mentioned just briefly there. You said we have an 81-year-old president that appears not to be on top of everything. Greg, specifically, what do you mean by that?
Well, I think when you hear him sometimes, he sounds hesitant, not clear. I think that he got way behind the curve, John, on the immigration issue. I don't think he fully appreciates how serious the crime issue is. So there are a lot of things that have the American public worried, and they get the sense that Biden doesn't share their anxiety.
You alluded to it. You still think there's a chance he's not the guy, he's not running next year?
You know, I said, just to be provocative, maybe, I said there's a 25% chance. But let's say he doesn't do well in some of the early primaries. That could be a factor. Not now, but I looked this up. LBJ dropped out on March 31st of 1968. So you could see somebody drop out later than January.
Greg, appreciate the input, the insight. Thank you, sir. Greg Valliere of AGF Investments. Greg, enjoy the Christmas holiday, sir. Fantastic to hear from you. The Democrats' king isn't Biden. This is Greg this morning in his note. The Democrats' king isn't Biden. It's Barack Obama. He goes on to say, who could win a third term if the Constitution allowed it.
Yeah, and then he went on to say, Obama privately is raising questions around the possibility of President Biden winning another term. We've heard this again and again and again. It's the private conversations, but publicly the message has been the same. We have a mandate. We are going to run again. Absolutely. Look at the economy. By a lot of metrics, it's doing really well. And by a lot of metrics, yes, it is. So then there is a question of why sentiment has remained so depressed. And you can't just reject the way people feel outright. So this frustration keeps persisting, even though they keep doing the same thing.
The president, and this is the word to Greg Valliere, the president struggles to connect with the anxieties of everyday Americans when it comes to the economy. End of story. People don't want to hear. They don't want these statistics shoved down their throat if they're not feeling good about where we're at in this country.
If they're paying $100 more for groceries every month or
Precisely.
every 2 weeks, then it's going to be really hard to make them feel good.
Equity futures right now just about positive from New York City. This is Bloomberg. Coming off the back of another day of gains on the S&P 500, equity futures look like this, just about positive on the S&P by 0.1%, on the Nasdaq up by 0.1% also. Some participation again beyond just the big tech names. Energy starting to playing off the back of the rally in crude. Tons of energy also going into clarifying the Fed's position. Goolsbee pushing back, others as well. Then daily of San Francisco in the Wall Street Journal, Bramo. Got my attention, got yours as well.
I think that actually was more interesting to me than some of the other pushback because it showed the shift in the balance of risks. There is just as much of a risk of really hampering the labor market as there is curtailing inflation. The fact that inflation is no longer the main concern is a massive sea change in the Federal Reserve that really underscores why cutting rates is not necessarily considered even being accommodative, that will still be very restrictive based on the implied disinflation that could come next year.
And try to get ahead of any potential weakness in the labor market as well, seems to be the message from San Francisco. Let's turn to the bond market, 2-year, 10-year, 30-year. We talked about these levels we were at in October, north of 5%, now south of 4% on a 10-year, 3.91. We're down a couple of basis points this morning on a 10-year. On a 2-year maturity, we're down a single basis point, Lisa, 4.43.
I keep thinking about the idea of a deficit. And everyone's saying next year is going to be so messy with the election, with the fact that Congress can't get anything done. So then when do we start caring about the deficit again? I'm just thinking that investors are now the most overweight bonds in 15 years. They are flooding their cash into bonds. At what point is there a head fake? Is this the cash being deployed? Have we seen the move out of cash already?
Is this the real deal? Not just in the bond market, but also in the equity participation as well? Or is this just people chasing underperformance through the year, trying to go to where the pain has been, pick up the banks again? We'll have a conversation about the banks a little bit later this morning. Let's finish on foreign exchange. The dollar against the yen. Dollar-yen gapping higher. Yen weakness, 144.73. That currency pair positive by 1.4%. Under surveillance this morning, the BOJ sticking by its negative rate regime, leaving policy unchanged and offering little insight on when to expect rate hikes to begin. Governor Ueda saying it's, quote, difficult to show exit plans with certainty. Jane Foley of Rabobank saying, quote, the yen reaction shows that clearly there is some disappointed in the market that Ueda did not lay down the groundwork for a specific exit policy. No sign of that at all, Lisa, into year end.
No, he specifically said he's not going to tell us what he's going to do. But this raises this question again, what is the goal? Do they want a weaker yen? Is that actually helpful in getting to their ultimate goal of keeping inflation up, especially because the economic data has been coming in a little bit weaker than expected? And I ask that because if they want to do this in a controlled way, they might want to do it before you start to see rate cuts at the Federal Reserve, because that will turbocharge any move stronger in the yen.
That tug of war between the BOJ and the Federal Reserve. One to watch. Elsewhere, shipping in the Red Sea grinding to a halt as attacks from Houthi militants force move companies to avoid the area. An unavoidable waypoint for ships using the Suez Canal. US Secretary of Defense Lloyd Austin calling for, quote, collective action and announcing a naval task force with allies to counter attacks in the region. Interesting quote from Torsten Slock of Apollo just yesterday saying rising uncertainty in the Suez Canal combined with the global economy rebounding because of easier financial conditions could put upward pressure on goods inflation over the coming months. Lisa, I know you're looking at the same thing.
Yeah, although every time I do, I just have to say that people send me GIFs or GIFs, however you call it, on Twitter or X, whatever you call it, showing bears running around and saying, what if, what if, what if? I mean, this is another what if, and we saw that with respect to oil prices before. What if oil prices surged on the heels of Middle East unrest? It didn't happen. So at what point is this yet another potential headwind that turns out to be remedied? That said, you can't ignore it if it counts for 12% of global trade.
Do you know how to get people to sell watches, or to buy them at least? Do you tell them they're going to be pulled off the shelves on Christmas Eve?
Are you buying an Apple Watch?
Isn't this just slightly convenient? I know this is not, obviously, not constructed by Apple. This is not a conspiracy theory.
Come on.
I'm just saying this is highly, highly convenient.
Heading into the Christmas holiday.
Precisely. That Apple will stop selling the latest versions of its smartwatch in the US. The company facing a patent dispute over the use of its blood oxygen sensor. The tech giant will stop selling the two models online December 21. And guess when they stop selling them in physical locations? Christmas Eve.
Exactly.
I mean, come on.
This is what, $17 billion of revenue for them.
Real money.
The shares are not moving, right? They're like down, 1% in response to the potential loss of this revenue, which means that no one actually believes they're not going to lose this revenue. Because if they did, there probably would be a bigger move. So here's the question. Is it to encourage people, buy your Apple Watch right now? Or is it to basically pressure the U.S. government to give some sort of stay so that they can keep selling it? This is not a conspiracy theory.
It's not. I'm just saying it's highly convenient. It's highly convenient that Christmas Eve is when they'll stop being sold. We'll leave that story there. Jane Foley, head of FX strategy over at Rabobank, joins us now, not to talk about Apple, but to talk about dollar yen and the BOJ. Jane, I thought it was a live meeting. Jane, apparently it wasn't.
You know what, I think if you were to ask many of the diehard BOJ watchers, they weren't expecting this to be a live meeting. In fact, if you look at both the Bloomberg survey of forecasters, of commentators for the Bank of Japan and the Reuters one, not a single soul thought that this would be a live meeting. And actually, I do think UAE's commentary has been really very consistent. They're in no rush. And why should they be in any rush? They're anticipating that inflation pressures are going to ease into 2024. There's no news there. But also, yeah, you know, if you take the comments that Ueda made about a month or so ago, he said, you know, they would rather inflation overshoot than undershoot, because if it overshoots, well, they just hike interest rates, which would be a great scenario for them. If it undershoots, if they hike rates too soon, well, they're just back in that deflationary environment that they've been struggling to cast off for decades. So they would rather have an overshoot of inflation here. They're in no rush to alter their policy settings.
Jane, there seems to be just a bit of excitement, I think, elsewhere on the prospect of divergence between central banks. The Federal Reserve starts to go one way, the BOJ starts to go another. What kind of degree of divergence are you anticipating in 2024?
You know, not a lot, because I don't think the Bank of Japan will go an awful lot. I mean, I think it's a fair comment now that if they go, then maybe they will choose April, for instance, because then they get the next year's round of wage rounds round. And there's some positive indications for that already. We've had one of their big unions suggesting that they may go for a 6% wage increase, for instance. Now, of course, we've got to remember that huge proportions of Japanese people are not unionized, they're not in unionized firms. So there's no guarantee that everyone was going to get really significant pay rises, but it is a good signal. And the wage rises that we saw this year at this spring's wage round were the highest in 30 years. So we're moving in the right direction. They just don't want to put themselves back. So I think April is a decent month to anticipate that they could move out of negative interest rates. But, you know, like Ueda commented really this morning in not so many words, they're data dependent like everybody else. So they're only going to go if they see more evidence of this virtuous cycle of higher domestically driven inflation, i.e. wage rises, pushing ahead with consumption, which pushes up profitability, and then you get that virtuous cycle going. So that's what they're waiting for. I think April's a fair bet right now, but we'll have to wait and see what the data says by then.
I have to be honest, data dependency is getting hard for me. It's getting harder for me and harder for me because it means different for different central banks, depending on the month, depending on the week, depending on what data is capturing public imagination. What about the data of the foreign exchange rate? Does this Bank of Japan want a weaker yen? Is that helping them achieve that virtuous cycle?
Well, of course, if you look at many of the companies on the Nikkei 225, well, they're very big exporters. So certainly for those, it is helping them. Now, the companies, if you go back a couple of years, when we had really higher commodity prices, much higher oil prices, for instance, it was really those mid-sized caps, for instance, that are focused on a domestic audience, so a domestic consumer. They were the ones that were really suffering because they had the high input prices and they couldn't pass it on through their export price because they didn't have the export price to do that to. So they were the ones that were struggling. Now, you could argue certainly that now that commodity prices, a lot of food prices, for instance, are a lot lower than they were, and you know they're probably going to be lower into next year too. Well, it does take the strain off the worries about the impact of such a weak yen. So I don't think it is such problematic. But again, we go back to this argument that no authority wants a fast-moving exchange rate. If something's stable, then they can work with it and they can move other policies around that. So as long as it's relatively stable, I think they'd be okay with that.
But that's the reason why I think a lot of people are questioning the timing and why they didn't go now, especially if the Fed is thinking about, or maybe not thinking about it, the market's thinking the Fed's going to cut rates in March. This would just turbocharge any kind of strengthening in the yen just based on the double barrel, the Fed cutting with them hiking. How much does that sort of create a problem for them in terms of the timing that you put out there?
I probably wouldn't use the word problem. but it certainly is a factor. And clearly, I mean, they're not going to tell us what they're thinking about dollar yen, but clearly, for all the reasons that we've just been discussing, it is an input for them. So if the movements in dollar yen were really quite extreme, if we started to move down very significantly, yes, that is going to alter the decisions that they make. So it is certainly a consideration. But again, it's just one factor in many. And again, it comes back to this view also. I don't think that the Bank of Japan is going to be moving significantly next year. They won't want to be moving in the opposite direction to all the other G10 central banks too much because of the impact on the yen. So, April is probably again in play if, like here at Rabo, the Fed is perhaps not going to move until slightly later in the year and not March.
Jane, let's get to the ECB and wrap things up there. How credible is the relative, and I stress relative, hawkishness of President Lagarde after what you heard last week?
Looking at that PMI data on Friday, I think it's difficult to be, to really get into that hawkish camp or that hawkish pushback. I'm actually of the view that, if you look at some of the problems, particularly with Germany, the competitiveness of Germany or lack of it, the fact that so many big energy users, big industrial users in Germany are really finding it tough dealing with the anticipation that energy prices, are still higher than they were and could remain higher than they have been, for some time because of the lack of cheap energy from Russia. I actually come to the conclusion that for the next cycle or two or 10 years or so, then Germany might even benefit from a weakened euro because of to try and aid its competitiveness. And we've got this issue about competitiveness in Europe. We've got Draghi working on that for the European Commission, and I think a weakened euro could be beneficial as long as inflation can be kept in check.
BNY Mellon say parity. Morgan Stanley, Matt Hornback thinks that maybe we head in that direction. Jane, what's your call for next year?
Well, we haven't got parity on the forecast table, but I do have a lot of sympathy with that. And, and I'd actually say if we move to the next 5 or 10 years, I think we're probably going to be more centered around, say, 104, 112 than anything higher, which is, from most fair value models, that's weak for the euro. But I think it's going to, Germany and the Eurozone is going to need a weakened euro in the next cycle or two.
The data on Friday was just absolutely terrible. Jane, thank you for the update. Appreciate it. Jane Foley there of Rabobank. We can revisit that data on Friday if you want. The PMIs, the composite PMI, 47. Dividing line between expansion and contraction is 50. Anything in the 40s is not great, but 47 is not pretty. Manufacturing, 44. That's sort of on the brink of ugly over in Europe.
Especially because other data confirms that. This morning we saw German business expectations going down, worsening for the first time since August, so moving in the wrong direction at the same time that the ECB is pledging to remain strong, which is a reason why no one believes them. And I think it's important to say, how credible is it if the data isn't there? Right now, it's not credible. And yet, what's going to be the trigger for them to change their rhetoric? That's going to be my key question.
This is why I think it's more than just selective hearing. And we talked about this in the last 24 hours. Any potential pushback from a central banker is only as credible as the data behind it. So when you hear Lagarde say, yeah, maybe no, on Thursday, you're like, yeah, maybe no. I don't think that's what's going to happen here. But when you hear the Bank of France governor talk up the prospect of rate cuts next year, you're like, yeah, that sounds about right. That's what I expect from the ECB. And I think it's the same thing for the Federal Reserve. For a lot of people, data can change, but given the glide path we're on right now, just feels like rate cuts are part of the conversation.
It seems like markets are in the lead, very much. They have been leading. There is a feeling that markets are getting it more accurately than the Fed. And so this was why I thought it was interesting yesterday when we were talking to different analysts that maybe the Fed is trying to not be bullied by the market, right? To create some sort of sense that they're not going to just follow suit with what the market is asking for. And yet the market has been right a lot. It's also been wrong, but it's also been right a lot.
What's that old line that the Fed says when we're going to hike and the market says when you're going to cut? And the market's like, you're going to cut, and a lot in 2024. We'll see. Catching up with Mohammed Al-Erin a little bit later this morning, 9 a.m. Eastern time, on this market being bullied, or rather this market bullying this Federal Reserve. More on that in just a moment. Andrea Enria, the chairman of the supervisory board at the ECB, on banking stress on the continent. That conversation up next.
We've had pretty sturdy growth, yet the inflation rate has come down. So the prospects of a soft landing have gone up. The market may be getting a little bit ahead of itself. This is how Powell thinks the world is going to evolve. Powell thinks the Fed's going to be cutting rates in 2024. But it's possible that the economy could be firmer for longer, inflation could be more stubborn, and the rate cuts might not actually turn out to materialize.
Bill Dudley was fantastic yesterday, the former New York Fed president and Bloomberg opinion columnist. He thinks this pivot, this apparent pivot, is a gamble. A big gamble. We'll discuss that through the morning. From New York City, good morning to you. The state of play right now, the scores look like this on the S&P 500. The S&P positive by 0.1%. Yields coming in a couple of basis points. We're down 2 or so on a 10-year, 391.45. And a focus on Europe, Lisa. 109.33 on the euro against the dollar. Slightly stronger euro this morning. But the data out of Europe just hasn't been great over the last few days.
The fact that German expectations among businesses deteriorating for the first time going back to August really highlights how things have taken a bad turn, especially at a time where the ECB seems determined to keep rates high to fight inflation, because that still is very much a problem.
That's the monetary policy story. Let's talk about financial regulation. 20 of Europe's biggest banks will need to raise their capital requirements next year. The ECB making the announcement at the presentation of its annual evaluation of the banking sector. Europe's top banking regulator warning that resilience this year should not lead to complacency. Quote, there are still significant uncertainties and downside risks. Economic growth will continue to be dampened as the ECB's monetary policy tightening and adverse credit supply conditions feed through to the real economy. I'm pleased to say that the chairman of the supervisory board, Andrea joins us right now. Andrea, wonderful to catch up with you, sir. Let's go straight to that quote that you delivered this morning. Where do you think there are specific pockets of risks that we all need to pay attention to in the year ahead?
Well, banks have shown to be pretty resilient so far. They have a strong capital position, strong liquidity position, big recovery in profitability, for the first time a double-digit return on equity. But if you look at the outlook for risks, of course, we need to keep remain very alert. Credit risk is still an area of concern, especially real estate, commercial real estate, so the segments which are more sensitive to interest rate, leverage finance, counterparty credit risk are the area of attention for us. And then funding and interest rate risk in the banking book. Funding risk and interest rate risk in the banking book, driven by the rapid changes in the interest rate environment.
One big focus on this side of the Atlantic, Andrea, has been what's happening in private markets. I just wonder, on your side of the Atlantic, how you're gauging what's developing in private markets. How are you monitoring that?
Well, we are also monitoring the exposures of banks. Of course, counterparty credit risk is the main element. No, is the area where banks are taking positions vis-a-vis non-bank financial institutions, and this has been an increasing area of attention for us. We should clear expectations on the banks to step up their onboarding practices, their monitoring practices, and their risk management. So this is definitely something we are looking into very, very carefully. But you know, the key issue is that with non-bank financial institutions, sometimes there is a lot of opaqueness. So there is a broader question whether maybe the perimeter of regulation should be expanded.
Do you get the sense that there's another Credit Suisse out there? And I say this with respect to another bank that could be forced to either merge or dissolve in short order in response to a sudden event.
Well, looking at European banks, I think they've shown remarkable resilience. If I look at the events of the spring of this year, the turmoil in the spring, I think the two things that made European banks stronger are the fact that the unrealized losses are relatively contained compared to, for instance, banks in the US. And the other fact is that they have a very well diversified deposit base. Still, this should not lead to complacency, as I said, because indeed we see that when there are these moments of turmoil, markets start to look at banks not anymore with their traditional balance sheet key indicators. They look at market value, at economic value of equity, and at the sustainability of business model. So these are the areas where we want banks to focus their risk management and to focus the improvement of business model sustainability. We think is key to be safer from these type of events.
Would you like to see more consolidation, particularly as you do look for capital raises to insulate against the next cycle?
Well, we have said from day one, since I joined in 2019, that we were open to see more consolidation. There was an issue of excess capacity still in the European banking sector, and consolidation could have been a good element to address that. And the other point is that having more cross-border consolidation, of course, would improve the private risk sharing, the ability to withstand risks in one country with profits, losses in one country with profits in another one. So we have seen some consolidation within borders, within domestic borders. We're seeing some positive acquisition of business lines, which have helped banks to refocus their business model. We have not been seeing cross-border consolidation. So our market remains segmented along national lines. In the long term, this is not good news. I think that this makes the market more fragile.
How does that change? What do you think sparks that change?
You know, of course, the easy answer is the completion of the banking union. So having a common deposit guarantee scheme that would create a common safety net and therefore would remove an important obstacle to cross-border consolidation. Still, I think this is not going to come for a while because we know that there has been a very fractious debate in the European Council. Member states have crossing red lines, so this is not going to happen any soon. I think the banks should take ownership of this objective. They should themselves invest into more integration in the European markets. We offer them some options. For instance, we have seen the banks relocating after Brexit. They have opened branches. They have transformed their subsidiaries into branches, and they are now operating in the single market without any local capital or liquidity requirements. We suggested that European banks can do the same. So far, we have not seen move in that direction, but that could be an interesting model to try to integrate more the market.
We've been talking about this for years. In fact, the conversation over the last decade has just been how much stronger the US banking system has been, how resilient the US banking system is. And then March happened. You touched on March. Andrea, I just wonder, as a European regulator, what the lesson from March actually was to see the failures take place in the United States and very limited failures take place over in Europe. Why do you think that was?
Well, there are different reflections that can be done. First of all, it's clear that in the US there was a more bifurcated regulatory framework, in which large, globally systemic important banks are responding in all senses to the international standards, while smaller regional banks are not subject to that. So a positive for European banks is that we apply the international standards across the board to all the banks, irrespective of their size. Another point is that, which is important, I think, is having more attention to economic value of equity. Not only, the increase in interest rates has been a positive for banks across the board, especially in Europe, where profitability was depressed for a long while. But of course, it can raise issues if you have large unrealized losses. And European banks were a bit better off in that respect. But still, we are seeing very massive outflows of deposits. So I think that funding and liquidity risk should be very much in the radar screen of supervisors going forward.
Well, given everything you've just said,
what we are doing right now.
Just to wrap things up, pockets of risk but still resilient, better performance given what we've seen take place in America earlier this year. The level of dividends, share buybacks that we saw this year, do you see reason for that level to be maintained next year?
Of course, that's not for me to decide. That's for banks and banks boards to decide. But yes, I think that banks have been particularly profitable. They are planning distributions which are in line with previous years. The last figure I saw, tentative, of course, and very preliminary, is around 70 billion of dividend and buybacks for 2023. Again, what we do is to check that these dividends and buybacks are compatible with the trajectories of capital for the banks, and if so, we have no objections to that.
Andrea, thank you, sir, for the update. Enjoy the holidays. Appreciate the catch-up. Andrea Enria there, the Supervisory Board Chairman at the European Central Bank. From New York City, coming up, Avery Sheffield of Vantage Rock. just around the corner. This is Bloomberg.
The Fed is done. We're moving from a rate hike cycle to a rate cutting cycle.
Cuts would suggest that you see continued economic softening.
The Fed's going to ease. They're trying to get that soft landing. Until we see data that it's not working, it's risk on.
The stronger and more resilient economic activity is, the more cautious I think they're going to be on the inflation hurt.
Overall, inflation is on the right path, and they know it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is risk on. The S&P 500 just off all-time highs. The Nasdaq 100 at record highs. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market just about positive 0.1% on the S&P 500. Lots of Fed speak. I know you're bored to death by it, but San Francisco Fed President Mary Daly saying the quiet bit out loud. Here's the quote: "We will still be quite restrictive, even if we cut rates 3 times next year. Plus, we have to be forward-looking and make sure that we don't give people price stability, but take away their jobs." That is not what we heard in August 2022.
It isn't inflation anymore right now. It is just as much, if not more, about the economy, about preserving the momentum that we're seeing and achieving a soft landing. That is a shift, and it really edifies this idea that baked into the Fed's own projections, they're going to cut rates 3 times. And to use Mary Daly's words, they still will be quite restrictive, even if they do that just based on the disinflation.
The Chicago Fed president suggesting that some of us don't know how the Fed works, that maybe they're not having that conversation at all. What do you make of the pushback we've seen in the last couple of days?
I actually have no idea. I don't understand it. I actually think that there is a question around whether Fed Chair Jay Powell knew exactly what he was doing, knew that the market was going to go flying, and actually wanted that because he was concerned about weakness and wants to achieve the soft landing at the risk of all else. And then other Fed officials are somewhat nervous about that. I have no idea how to understand it otherwise, because people aren't stupid. They heard what they heard, and that's basically what you're getting in the market.
This is what you heard from Chairman Powell. The question of when it will become appropriate to begin dialing back the amount of policy restraint in place is clearly a topic of discussion now in the world, and also a discussion for us at our meeting today. John Williams, New York Fed, we aren't really talking about rate cuts. Now, I mean, come on.
Okay, you could make some argument that there's a question of what really means. Let's define really. I mean, just to be completely honest, there's a question of how closely are they analyzing the possibility of cutting rates. Either way, this is just details that don't really matter, because the point is for markets, A, they're not going to hike rates again. That's off the table. B, they're more concerned about preserving the economic trajectory upward rather than some sort of fast deterioration at this point than they are worried about inflation, which seems to be somewhat under control right now. And that, I think, is the message that everybody heard loud and clear.
Precisely. This is the recipe for higher stocks. Here are the ingredients. This is Stuart Kaiser of Citi. Strong growth, easing CPI, a pausing FOMC with positive stocks. The Fed's just extended the window into 2024.
But you raise a point. It has to do with data. Does the data cooperate? And what is the potential for a reacceleration of inflation? What is the potential for economic data to come in stronger than expected consistently, and people start to question these? These are some of the mood killers that lead some people, including Lori Calvasina of RBC Capital, to say there could be some sort of mild pullback. This is the new consensus. January might be rocky, but it's an entry.
Killer?
Yeah. And then that's
slight pullbacks.
Slight pullback, but buy it.
Okay. Slight pullbacks, but buy. That's the Grinch this year.
Well, I mean, literally, we heard from Jason Trennert, the Fed shot the bears. So where are they?
Yeah, sure. There are hardly any left.
Yeah,
Mike Wilson, green light for a ramp up in stocks. That's Mike Wilson at Morgan Stanley. The bear sounding somewhat bullish. Equities right now, the scores look like this on the S&P. Positive by 0.1% on the S&P 500. Yields coming down 1 or 2 basis points to 391.45. And the euro just a bit stronger, dollar weaker. On that currency pair at least 109.42.
And this has to do with the data over there, as well as people try to understand what the ECB's reaction function is going to be. Today, 8:30 a.m., U.S. building permits for November come out, as well as U.S. housing starts. This comes at a time when mortgage rates have plummeted. The high on October 25th was 8.1%. Currently, we're at 7.1%. How much does this fuel another round of optimism in housing? I don't know that many people want a mortgage at 7%, but still something to watch. Today, Fed speak, the Fed pushback. Richmond Fed President Tom Barkin lining up at 9:30 a.m. Atlanta Fed President Raphael Bostic at 12:30 p.m. And at 6 p.m., we hear from Chicago Fed President Austin Goolsbee, who told us yesterday that he doesn't understand why markets are reacting the way that they're reacting.
I'm happy to explain. We'll just go through the transcript from the news conference on Wednesday. It's not difficult, is it?
Well, and this is sort of the question, right? Why? What's the hope here? Is it that they don't want to be bullied by the markets? Is it this question of dissent on the committee, that some people are willing to let her rip and some people aren't?
The reporter over at the Wall Street Journal got a baseball and just did that, chucked it up.
Underhand,
softball, and basically said, easing financial conditions, what do you think? Meh. No pushback whatsoever.
None.
That's what stood out to a lot of people. Mike Wilson, Morgan Stanley, no pushback, easing financial conditions. Rick Reeder of BlackRock saying exactly the same thing to our team yesterday afternoon. Surprised by the lack of pushback to easing financial conditions. How can you walk away from that news conference and be surprised by what happened in financial markets? How?
You can't. And I don't think that Fed Chair Jay Powell was, ignorant of how markets would respond. Again, maybe he's more concerned about economic weakening because of some of the anecdotes than other members are. I don't know. I'm not a psychologist. Let's get one on and maybe we can do better. After market, we get FedEx earnings. And this, to me, is really interesting because those shares are up about 63% so far this year, gaining market share from UPS. This, to me, is interesting after some of those union negotiations. So can they deliver going forward? The look-aheads are also going to be interesting. I love the shipping and logistics areas.
Likewise.
I think that it's all logistics.
Big fan of Maersk and all that good stuff.
Oh, totally. I think it absolutely
We'll talk about shipping of the Suez Canal a little bit later in the programme. We need a therapist for equity market bears. That's what we need for year-end.
Sure.
A therapist for the bears.
I'd like that.
Avery Sheffield joins us around the table. She's not a therapist. She's the co-founder and CIO at Vantage Rock at Rockefeller Asset Management. Avery, great to catch up with you. I want to talk about a sector I know you're focused on. It's the banks. The banks are up 25% on the S&P since the end of October.
Yes.
Do you think there's more to come?
I think that they're still very cheap relative to the rest of the market. And the reason is that, we are likely, it's everything you've been discussing, right? We're likely to continue to see a steepening of the yield curve, which of course is the ideal environment for banks. And I mean, the Fed has told us, I know they're trying to potentially walk it back a bit, but they're not going to let this economy weaken in any material way. And they're not saying it, but I think that they're going to be willing to have inflation be a little bit higher if they're concerned at all about the jobs market. And we have seen some anecdotal evidence of, a few increased tech layoffs. I mean, nothing's in the numbers yet, but Mary Daly's out there very dovish. Maybe they are concerned a little bit about credit weakening, and if because of jobs, coming in a little bit weaker, and so the Fed, I think, would even accelerate the three cuts that they're talking about if they perceived any weakness, which is good for credit for the banks.
Is it good for what's happening elsewhere, for energy, for some of the cyclicals? When we're going to start to see broader participation, what makes that sustainable if you're talking about weaker growth and job losses?
Right. So what I'm saying is, I think they're going to prevent it. I mean, right? The loosening of financial conditions that has just happened in the bond market, in the equity market, is stimulatory, right? So there are companies that might have been considering laying people off, but they're seeing rates are down. We actually think maybe there'll be some growth this coming year because consumers will have less to pay and interest rates on their credit cards. And so we're not going to lay off people that we would otherwise. You have companies in private equity, in VCs, that'll be able to refinance debt and keep those jobs alive. So what does that mean for energy? With energy, of course, we have a very large supply dynamic, right? With the Permian having coming in with stronger supply than anticipated. You have China dynamics. But the Saudis have, said, okay, we're going to put a bottom on energy, and you have energy traders looking for a catch-up trade. So I think energy probably doesn't go down from here. Energy could be a big surprise to the upside, especially with supply chain logistics that we're seeing in the Red Sea and elsewhere. But I think there are other areas of cyclicals that don't have the same supply dynamics that could have further to run, and certainly much further to run than a lot of the very expensive stocks in the market that are what has have led to the massive rally over the past 12 months.
So Jay Powell wants to make people happy.
Yes.
OPEC Plus is putting a floor under oil prices. There's no free lunch. Is this going to come in the form of higher inflation over the long term? Can you start to feel less good about long-term bonds?
So I do think that the risk is to the upside in inflation absolutely with a Fed that is as dovish as it is right now, and this floor under the energy markets. The thing is, that's going to take some time to materialize, right? So we're not going to see it right away. So will, like, the second half of the year, and maybe things are happening so fast or it happens faster, do we have, like, people more concerned about inflation because we're seeing it come through in the numbers? Yes. But, like, at this point in time, we do have enough weakness in consumer, the most recent consumer discretionary spending, right, has real pressure on it because of, we have the COVID savings have really, the discretionary part of the COVID savings have largely worn out. We have people worried about their student loan repayments, and people still have been worried about their jobs in companies that are weaker. So I think that tampens some of the inflationary dynamics in the near term. But longer term, absolutely, I think we're set up for inflation to run higher for longer if this kind of loosening continues.
Can you give us a sense of just how much more bullish you got after that press conference? Basically, did you go out and just press buy?
I think, yes, absolutely. I mean, I think we saw it. What was interesting is the last time I was on Bloomberg, I was actually very bearish because I was concerned about rates being higher for longer and everyone really being concerned about the risks of inflation to the upside. And then, the Fed being concerned about inflation reaccelerating. But the data points we were seeing right then were actually very concerning. And so instead of being bearish, what you needed to be was bullish to say, the data is getting worse, so rates are going to come down, and that's going to loosen financial conditions. And what we saw again is we saw that Powell really was channeling his inner Bobby McFerrin, don't worry, be happy. In the press conference, something happened in the past few weeks where he probably was seeing some data that was concerning him that things could get worse. And so as a result, he decided, loosening financial conditions don't matter because I'm more concerned about jobs than I am about inflation reaccelerating at some point. And if all they're focused on is jobs, there's going to be a really high bar for them to actually become materially more hawkish. At the same time, the market has even gotten ahead of their 3 cuts, right? They're still not talking about cutting anytime soon.
Maybe.
Right. I mean, but if the data is negative, like, there is this Fed put there, like, they are going to support this market. They don't care about valuations of stocks that don't make sense to me in a lot of cases. So when we look at the market as a whole, we think the market as a whole is very expensive. We see analysts continually chasing, like, oh, this company's going to bring down numbers, but everyone knows it, so we should pay a higher multiple. We don't think, though, that's sustainable forever, but we do think that in more cyclical areas of the market, valuations are still much lower than elsewhere. And so running a long-short portfolio, it is, I think, wiser to pay attention to valuation in these times.
The balance has shifted at the Federal Reserve, without a doubt. Avery, it's good to see you. Thanks for joining us. Avery Sheffield there of Vantage Rock at Rockefeller Asset Management. If you are just joining us, welcome. State of play, the scores look like this. The S&P 500 positive by 0.1%. Yields a little lower by 2 basis points, 390.89. Crude softer, rallying through much of yesterday. We're back to 72.40 on WTI, negative by 0.1%. Tons of feedback on the effective shutdown of the Suez Canal. Started with Torsten Slok over at Apollo, who said this: rising uncertainty in the Suez Canal combined with the global economy rebounding because of easier financial conditions, Torsten says, could put upward pressure on goods inflation over the coming months. This just dropped from Andrew Honhorst of Citi. The effective closure of the Suez Canal trade route is now an upside risk to goods inflation. Lisa, I know it's a topic you're watching closely.
How could it not be? This is the exact same thing that we saw when shipping channels get disrupted. That leads to a longer wait time to get supplies. And that means also more expensive costs for the extra fuel, for the extra hours. I mean, this is all kind of a clear trajectory to higher prices. It's just the big if this gets prolonged. If
Anne-Marie joins us on the if up next in Washington, D.C. If it gets prolonged, what can officials do about it? Then later, 8:30 Eastern Time, 1 hour and about 16 minutes away, Rich Clarida, the former Federal Reserve Vice Chairman, and PIMCO Global Economic Advisor from New York City this morning. Good morning.
The bottom line is that we've got to get it done, both the military assistance to Ukraine, other military assistance, as well as addressing this border security issue. And of course, at the end of the day, we're going to need bipartisan support to do that in the Senate. We will have to come together to get this deal. Exactly when, as you say, is not clear. Progress is good, but we need to get it over the finish line.
Is that support there? That was Democratic Senator Chris Van Hollen speaking to Anne-Marie Jourdain and Joe Matthew on Balance of Power last night as signs of a border deal diminish going into the new year. From New York City coming into this morning, good morning to you. Equity futures on the S&P positive here by 0.1%, elevated over the last couple of months. We're looking at the prospect of 4,800 on the S&P 500 a little bit later this morning. Yields are lower by 2 basis points, 390.70. Elisa, the everything rally continues.
And there's no real reason for it to stop, as we keep hearing from one investor after another. The Fed has told us their game plan, and if there's weakness, they're going to come in with the Fed put. And that has been the message, regardless of how much walk back we try to hear from some of the other Fed officials.
Jason Trennert, Strategas, a second wave of inflation.
Yeah.
Starting to consider a second wave. Things happen. What's happening right now is that traffic going through the Suez Canal has been grinding to a halt through the Red Sea. And this is what we're hearing on the south side, on Wall Street. This from Andrew Hollenhorst of Citi. The effective closure of the Suez Canal trade route is now an upside risk to goods inflation. We heard on the buy side from Torsten Slock over at Apollo that rising uncertainty in the Suez Channel, combined with the global economy rebounding because of easier financial conditions, should put upward pressure on goods inflation over the coming months. Could, Lisa? Could put upward pressure, and this is a could we're all going to be watching.
Especially because it's unclear what the coalition is going to do without the participation of Middle Eastern nations. If you noticed, the list of the coalition that came together to try to protect this shipping channel included Europe and included the U.S. It didn't include some of the biggest players who could potentially pressure the Houthis or other players in this. I'm not an expert in this. I really want to understand from experts exactly what needs to happen to make this a viable shipping channel at a time where insurance costs are skyrocketing, and so too are fees.
Well, let's get to someone now who knows what's happening. It's Anne-Marie Jourdain, our chief Washington correspondent down in Washington, D.C. AMH, let's start there. What's being done to reopen that channel?
Well, right now you have the Pentagon talking about a new maritime task force to try to make sure that there's security within the Red Sea and this channel. The issue is, Jonathan, is that a maritime task force already existed here. The U.S. has 2 aircraft carrier groups here, but obviously there's a tremendous amount of concern amongst companies right now, given the attacks they are seeing from the Houthis. But what you can see is that the United States is trying its best to work with international partners to try to make sure that companies can continue to use these waterways and not have to redraw the map for goods, for oil, because what that would do would be another shock to the system, which global economies have already lived through with the pandemic. So there's going to be this international outreach, this maritime consortium, but we should remind our viewers that this already exists. So I'm just questioning what this new group can do that the prior structure was not doing.
I want to understand, Anne-Marie, what's on the table. I mean, is this basically a reluctance to take military action against the Houthis or to have something more sustained and to try to talk it out instead? Is that basically what this is aimed at?
Well, at the moment, the Biden administration wants to use diplomacy. They do have ways of dealing with Iranian proxies via diplomatic channels, most notably in Oman. What a source has said to me that there's a lot of debate right now and friction within the Biden administration on if they go on the offensive or, I guess, the defensive, but actually attack the Houthis, which we've already had missiles come at our ships and other cargo ships in this area. There's a lot of debate because does that mean the United States is going to get involved in another conflict in the Middle East? So that is the debate right now as they are trying to unwind or trying to put some pressure on the Israelis, or a tremendous amount of pressure at the moment on the Israelis, so they can stop their bombing when it comes to Gaza and their attack right now in southern Gaza. So while the United States is trying to force the Israelis to really start to slow down their offensive in the Palestinian territory of Gaza, what you have at the same time is their consternation and concern about getting drawn into another conflict when it comes to the Houthis.
I'm just wondering, Anne-Marie, I know that you have a lot of conversations off the record with a host of different officials in Washington. Do you get the sense that people feel like this is going to get resolved? Or is this a real concern where people don't have a sense of exactly how they can unwind this in an easy way?
Well, if you're talking about the Houthis, this has been an issue for years that the U.S. has dealt with via their allies, whether it's Riyadh or Abu Dhabi. I'm not sure anyone thinks this can get unwound very quickly. This is why they're doing a tremendous amount of diplomatic outreach to the Gulf and via Oman, Bahrain, Saudi Arabia, and the United Arab Emirates. The concern, of course, is this is a massive risk, not just militarily, but of course, what does this mean for global economies, the supply chain risks for goods, if you have to redraw the map? That is going to be inflationary on goods and also on oil. And right now, it's been a sigh of relief for this administration that you have gasoline prices in America where they are, just hovering a little bit north of $3 a gallon. But when you continue to look at poll after poll, and just yesterday, the President of the United States received his lowest approval rating since he took the job in this Monmouth University poll. And only 3 in 10 Americans think that he is doing a good job when you look at the concerns that are top of their mind, most notably the economy and inflation. So this has dual potential concerns for this administration. Of course, it has the defense and military concerns of our armed service men and women in the Gulf, but also what does this mean politically going into an election year?
Let's bring it home and talk about what's happening domestically then. This from Greg Valliere of AGF this morning, Anne-Marie. A gloomy holiday season for Democrats. It's impossible to exaggerate the mood of despair among Democrats in the nation's capital. Anne-Marie, from your perspective, just how bad is it?
Well, it is pretty bad. And we saw yesterday that the Biden administration, Biden himself, is talking to his team, according to the Washington Post, asking, why is my message not resonating? Why are my poll numbers so poor? But you know what stuck out to me, Jonathan, in that Greg Valliere note today is building on the Wall Street Journal reporting over the weekend, quote, Obama has huge clout within the party, and we're hearing that he is privately telling Democrats that Biden probably can't win. This is not news. Your former president you used to work for when you were VP, this is not welcome news for President Joe Biden or his team.
Next paragraph in the same note, Greg asked the question, is he dropping out? Everyone's been asking that question for a long time. Any sign of that whatsoever?
Not at the moment. Not at the moment. He's not dropping out. And for someone to get in, it'd be incredibly challenging at this stage of the game. It is very late in the year. They would have missed the filing deadlines in a number of key states. Potentially, if things do not look good for him in the summer. But, I mean, I think this is some people just hoping for something new within the Democratic Party. But at the moment, Joe Biden is set to be their candidate in November of 2024.
AMH, thank you for the update down in Washington. Anne-Marie Horton there, our chief Washington correspondent. Lisa, let's build on that. The calendar. The one thing arguably on his side is the calendar. That we've got another year to go, 11 months, 12 months.
And that so far this has been more of a proxy. The sort of polls have been more of a proxy on how people are feeling right now and their anger toward the inflation, toward specific issues with President Biden. Donald Trump hasn't been the news. He's been sort of the other guy, right? He's been the fallback guy. It's not necessarily, the polls don't show that there's an incredible amount of enthusiasm. It's just that there is a lack of enthusiasm right now for President Biden. So this raises this question, is he operating in the same kind of way that President Biden did to win the presidency the first time by simply being, I'm not the other guy, rather than running as who he is himself?
Well, think about how the election played out last time around. We're just coming out the depths of the pandemic. The current president barely even campaigned, didn't need to, made it a referendum on the incumbent. And now you face a very, very different set of circumstances going into 2024.
And, you know, we keep asking this question on the economy, which a lot of people say is not doing well. The economic data points to something different. So if the frustration is building at the White House, what are they going to do about it?
Amazing how miserable everyone is in Washington and how happy everyone seems to be on Wall Street with this equity market rallying back towards all-time highs, isn't it?
I mean, at certain...
Quite a difference.
It's just a complete opposite. We've had a huge wealth transfer from the government to businesses over the past, 6 years.
Corporate America to consumer household balance sheets as well. That's been the pandemic story, I guess.
And I guess people are very happy about that.
They're miserable in Washington. Apparently they're happy on Wall Street. Equities right now on the S&P positive by 0.16% from New York City this morning. This is Bloomberg. Stocks are just about positive. They've been positive now for the best part of 2 months on the S&P 500. Grinding higher again by 0.1% on the S&P. On the Nasdaq by 0.1% also. The Russell, the small caps, really leading the way on many an occasion over the last week or so, up by 0.6% on a Russell this morning. So we've got a Nasdaq 100 at all-time highs, Lisa, and S&P 500 not too far behind.
And really, this raises this question, okay, is this truly the rotation that we've been looking for? Because we've seen head fake after head fake with the Russell 2000 outperforming. We've finally seen it over the past month. Can you bet on that? No one's willing to say we don't like big tech. That's one thing that I hear. People might say, well, we're rotating into cyclicals, but we're still holding a lot of big tech because that's always going to win. And if anytime you try to bet against it, you get slammed.
Price always sets narrative. We often say that, everybody says that, and you're always trying to find explanations for what's happening, and then people start to extrapolate the present out into the future. The issue I have with the rotation, the breadth, the improving breadth, is it anything more than people have underperformed in 2023 and are chasing gains and don't want to go to the high-flying tech names, so they go elsewhere to the places that have been beaten up? And when I look at the banks, are the banks anything more than just a leveraged play on what's happened in the Treasury market over the last couple of months?
I would argue no. It's been a very direct correlation. There is, though, this underlying feeling that if the Magnificent Seven has gained, 76% so far this year, 75%, something like that, year to date, the rest of the overall index, about 12%, if you believe that the conditions are set that are more in line with where the high flyers have been, well, then play catch up. And that sort of makes sense at a time when you feel like there is the Fed put back in the game.
You start thinking about small caps and an equal weight S&P 500.
Europe.
You know, if you equal weight the Mag 7, you know, if you equal weight them, so you give NVIDIA a little bit more weight than you would have done, there's something like up 100% or something like that.
That's nuts.
It's ridiculous. And then you play into Meta and all of that stuff too. It's amazing to me that Apple is up something like 50% year to date, when if you look at iPhone sales this year, not been tremendous, not been great, just a cash machine, just an absolute cash machine.
Yeah, but Apple Watch is flying off the shelves. So there you go.
We'll
Maybe
get to that story a little bit later.
Yeah,
you know my thoughts on that. Just the convenience of, no, it's coming off the shelves on Christmas Eve. Oh, no. Oh, they're terrible. Okay, let's turn to bonds. 2-year, 10-year, 30-year. Go and buy an Apple Watch right now.
Yeah.
10-year yields down by 2 basis points. 390.70. 2-year down by 2 basis points. 442.25. Lots of Fed speak. I think they stand out for me. San Francisco Fed President Mary Daly, look, on the dovish spectrum on the FOMC, most people would assume that, becomes a voter next year, the San Francisco Fed, talking up 3 rate cuts as not being particularly accommodative anyway, which is where the consensus is right now in the committee based on the median dot and what's implied for next year from this Fed.
If you have disinflation, according to Mary Daly and according to many people in the economics profession, cutting rates is simply keeping conditions in line with where inflation is at. And that's basically what she said. If they cut 3 times, they're still going to be quite restrictive based on where they expect inflation to come in. So here's the question. Is inflation, A, going to come in? And B, is it going to be a head fake, especially with the likes of Andrew Hollenhorst and others talking up the probability of a reignition of inflation later in the year?
Jason Trennert, Strategas, on this program earlier this morning, talking up the prospect of maybe a second wave of inflation next year. Let's turn to foreign exchange, the dollar against the yen. The BOJ, about a month ago, this meeting was meant to be live, and then in the last couple of weeks, this meeting's no longer live, and nothing really happened. 144.58, dollar yen gapping higher by more than 1 full percentage point. That is a weaker Japanese yen. More on that in just a moment. Under surveillance this morning, Houthi attacks shutting down shipping in the Red Sea. US Secretary of Defense Lloyd Austin saying the US, UK, Canada, France and other allies agreeing to a new naval task force to counter attacks in the region. Quote, this is an international challenge that demands collective action. How quickly, Lisa, can they move?
And what exactly are they going to do? Because none of these countries actually want to have a military altercation. They don't want to put some troops on the ground to make sure that there is free passage here. So what are they going to do? Can they jawbone this? Can they get the allies in the Middle East to collectively prevent these attacks? There are a lot of big questions, and I don't know exactly what the fair pricing is, but we have seen a pop to oil prices and people saying there's more room to run there.
Things are pretty calm in the commodity market. I know we saw a big pop in natural gas prices in Europe yesterday, but oil's still in the 70s on Brent. WTI about 72 this morning. Let's turn to the BOJ. Leaving its policy rate unchanged, the decision in line with the ECB, BOE and the Fed, who all held rates steady. But unlike Powell, Governor Ueda offering little insight on when to expect policy to change. The San Francisco Fed President, Mary Daly, did entertain rate cuts, telling the Wall Street Journal it's appropriate for policymakers to begin contemplating cuts next year, but it's too soon to speculate on when they might happen. So are they talking about it, Lisa, or are they not talking about it?
Jay Powell said they're talking about it. They're talking about it.
William
Period, full
says
stop.
we're not talking about it.
We're not really talking about it.
Oh,
but
we're not
really
really.
means
Okay.
sort of, a
We
more
are,
sort of
but we're not
prescriptive way.
really.
We're not
Okay.
saying the date. We're not giving, writing up the documents yet. That's basically how I interpret it.
Well, I'm pleased we cleared that up.
Yep.
So no more Fed speech through the rest
We're
of today.
good. We're good.
Top story this morning, Apple. It's not really, but I'll go to it. Taking some of its best-selling devices off the market this holiday season. Kinda. The company will stop selling the 2 latest versions of its smartwatch in the US due to a patent dispute over its blood oxygen sensor. Online sales stop Thursday. Store sales end on Christmas Eve. The convenience of these dates. Look at the stock. Does not care.
Yeah, does not care.
Just about positive in the free market.
This is a $17 billion line of revenue each year for them. So if people thought that this actually was going to be going away or impeded in any capacity, you would see a bigger reaction in stocks. Either way, this is basically a new marketing scheme. We have a concern about copyright. You might not be able to get my product anymore.
After Christmas. Buy it now.
Well, I mean, honestly,
okay.
I don't know. The fact that the shares aren't responding gives you a sense of what they think.
It tells you everything you need to know, I think. Let's get to the bond market. Subhadra Japa, head of US rate strategy at SocGen. Subhadra, I want to talk about your call on the bond market. It's refreshing. It's not super bearish. It's not super bullish. It's just neutral. Subhadra, why is it neutral?
Well, into your end, I think that we've already seen a very large rally in treasuries in just the last few weeks. So it doesn't make any sense for the market to continue to rally from here on. We think that the bond market, at least over the near term, is going to lose some momentum, given the fact that we're priced nearly for 6 cuts for next year. So that seems a little bit dramatic. I think our view is that the Fed will deliver a hike starting in May, but a March rate cut definitely seems a little bit premature at the current time. As you were discussing earlier, John, you're looking at an outlook where financial conditions have eased quite dramatically. Inflation is coming down very nicely. Gas prices or oil prices in general have declined quite meaningfully. So the consumer is still relatively strong. So the risk here is that we might see a resurgence in services-side inflation.
Let's build on that a little bit more. Where would that leave the call on the yield curve? Because traditionally, when we're talking about maybe the end of cycle, maybe the start of a rate-cutting regime, you'd get that bull steepener come through the curve. Subhadra, what's the call for you and the team now through next year?
So our call in our outlook that we published in the end of November was that the first move would be towards a bull flattener with the front end pegged and the long end rallying, but that hasn't happened. The market has priced in a lot of cuts in a very short amount of time. But the long end has also rallied, so the two-stance part of the yield curve is still quite inverted. You are going to see that disinvert and steepen out with the as we progress, but that's going to be more of a mid-2024 story when the Fed starts to cut rates aggressively. You're going to see that curve steepen out. So for now, I think that inversion is very much in play because investors are getting back into the bond market in a big way across the curve. You're seeing this FOMO trade play out, and that would mean that with the front end pegged to Fed expectations, investors are going to also buy the long end.
I was struck by the Bank of America Global Fund Manager survey that showed people really going out of cash and into bonds. Cash was cut to a 2-year low, and people were the most overweight bonds in 15 years. Have we already seen the rotation out of cash, out of money market funds that would have transpired given the potential for rate cuts?
Well, I think that what you're seeing is an asset allocation towards bonds, given the fact that people have concluded that bond yields have topped around 5% is as high as it gets. If that's the case, you're going to get the best yield you've ever had in the last couple of decades. So it makes sense to allocate into bonds as well as perhaps other assets, but bonds first, because the sequencing, the way it's going to work is, as the Fed prepares to cut rates, the economy slows down, You're going to see bonds rally first. And then if we do see a recession like we're expecting at South Gen by the middle of next year, then you should see some weakness in equities. And then you'll see the asset allocation into equities. But that's really not how it's playing out. There's just a lot of cash in the system, $6 trillion or so, close to that in money market funds. And that cash is just being reallocated into other assets where you could potentially get higher returns over the longer run.
So can you give us a sense of how much lower you think 10-year yields are going to end next year, given the fact that there still is a lot of cash to flow into bonds and you do expect weakness in the economy?
So, our call for 10-year yields is for 10s to get to around 375 by the middle of next year. And the reason for that is because we think that the U.S. economy goes into recession. So we do see more room for 10-year yields to rally. I mean, granted, when we put out these forecasts, 10-year yields were close to 5%. So 375 seemed like a stretch, but we're almost there in a very short amount of time. Could we see 10-year yields dip below 375? Perhaps. But really, the core story that I think that I'm sticking with is the fact that the sort of term premium buildup that we saw over the last, I'd say since August to the end of October, that story is still very much in play. You're seeing the supply-demand imbalances continuing to plague the market. You're seeing tailed auctions. There's just not as much demand for treasuries as we've seen in the past. And the Fed, our call is that the Fed is going to continue to do QT, not just into the end of 2024, but also into 2025. So given that sort of dynamic, it makes sense that you start seeing a buildup in term premia once the Fed starts cutting rates and the economy starts to stabilize.
Subhadra, this was excellent. Just fantastic to hear from you. Thank you. Subhadra Japa there of SocGen on this bond market. Lisa, let's piece it all together. In the equity market, the calls very similar to the calls in the bond market. So people like Subhadra making a call for next year on the US 10-year, looking for the yield to come to 375 at a time when they're putting that together, the yield's at 5%. Got the likes of Goldman Sachs coming out and saying 4,700 on the S&P 500. Oops, we get there, and then they have to lift their price target through 5,000 for year-end next year. They're chasing it. They're chasing the equity move because there's a feeling that something changed with Chairman Powell last week. I didn't hear that from Subhadra just then on the bond market at all.
And as she was speaking, I was wondering, is the bond market different because it is going to be more susceptible to some of the quantitative tightening, the selling or the rolling bonds roll off the balance sheet, as well as a deficit. And it's going to be a political season. It's going to be one where we're not going to get a whole lot of resolution when it comes to just how much the deficit has been expanding.
Subhadra Japa there of SocGen. If you are just joining us, welcome to the programme. On the equity market, just about positive on the S&P 500 by about 0.15%. Yields are lower by a couple of basis points. We're down 2 or 3 to 390.51. Coming up in the next hour, a conversation you do not want to miss. It's Richard Clarida, the former Federal Reserve Vice Chair and PIMCO Global Economic Advisor. Lisa, you'll be leading that conversation at about 8:30 Eastern Time.
You can stick around. This is going to be a key one. I think it's going to be interesting for him to parse through the discrepancies between the tone of some of the Fed officials. What does he make of the fact that Fed Chair Jay Powell has a very different tone than, say, Austin Goolsbee, and that they're both saying that they're on the same page, although we haven't heard from Jay Powell? I would be curious if he'd come back out again and say, hey, I said what I said. I meant it. Newport
Beach, California, June of this year. PIMCO releases their secular outlook. I sit down with Rich, and he talks about this Federal Reserve accepting 2-point-something inflation. 2-point-something. Wasn't the big conversation at the time. You'd have to think that maybe the world is moving towards Rich based on what we saw take place last week.
That's what Avery Sheffield was saying, that essentially this was a tacit acceptance of a higher inflation rate for longer in order to preserve the jobs economy. That was really the shift.
Alex Webb on a big story with Apple coming up next. Lisa's excited for this one.
Oh, yeah.
Go get your Apple Watches before they come off the shelves on Christmas Eve. From New York City. A beautiful New York this morning. Good morning to you.
If you have inflation that is decelerating and rates that are coming down, that tends to be good for growth. We want to be a little bit cautious around the Magnificent Seven, given the rally there, given the 40% overvaluation there of those stocks relative to history. It's about a third of the index if you look at the top 10 stocks, but only about 20% of the profits. People think all the profits are coming from the Mag 7. There are other sources of profitability. So I do think we think a little bit about the broadening.
We've seen a lot of that in the last couple of months. The brilliant Mira Pandit there, global market strategist at JP Morgan Asset Management from New York City this morning. Good morning and welcome to the programme. Stocks more broadly positive on the S&P by 0.1%. Yields down again by 2 or 3 basis points, 390.33. We're talking up the everything rally. Bonds rallying, stocks rallying. And for a moment yesterday, Lisa, commodities joining in.
Because, though, of a different reason, right? And so this is really what people are watching. This could be a potential red herring rather than something participating with everything else. Concern around shipping routes, one of the biggest in the world, getting blocked by Houthi militants attacking shipping container ships, as well as tankers, oil tankers. This, to me, is a huge potential headwind if it continues. I don't know how much clarity we're getting right now about what the parameters are of it continuing.
How many Apple Watches go through the Suez Canal? Do we know the answer to that?
I don't know, but I do know someone who does. Alex Webb can give us all of that.
Alex Webb joined us now, scrambling to get those numbers. Alex joined us out of London. Alex, a serious story, so let's focus on the serious aspect of it. So we're days away from a US ban, a potential US ban of the smartwatches, the newer smartwatches that Apple is selling. What is that issue right now currently, Alex, and how do you see it being settled?
So essentially there's a medical device or technology company out in California called Masimo, which has successfully asserted that Apple infringes upon its patents with the blood pressure monitor in its most recent smartwatches. And so the International Trade Commission, that's a US government agency, has therefore said that Apple cannot sell these devices starting on December the 25th. So there is the possibility always that there's some sort of settlement between Apple and Masimo. It doesn't look like that's going to be the case, at least based on our colleagues reporting. What Apple is now trying to do is find a workaround on a software basis, that it will change the algorithms in a way that therefore don't infringe upon the patents. Unclear whether they can do that, because this looks like it might also be a hardware problem. So there's a few different possibilities, but right now it looks like starting on Thursday you won't be able to buy them online in the US, and starting on Christmas Eve you won't be able to buy them in Apple's own retail stores in the US.
Alex, just to build on that a little bit more, any signal from Masimo what they would like out of this dispute?
I mean, they've said that the statement they've given is that this shows that no matter how big the company is, you can't just use your weight to get whatever you want. Typically in the past, in these sort of cases, there have been financial settlements. Now, there are estimates that that the Apple Watch generates something in the order of $17 billion a year in sales. Only then a slice of that will be for the affected devices here. It's therefore unclear. Presumably then there would be some sort of settlement. There will be a slice of the profit that they make from those devices. But we're a long way from seeing that happen, even though a lot of other cases that don't involve Apple tend to lead in that direction.
As you're talking, Alex, shiny pictures of the Apple Watch are flashing on the screen with all of the potential bonus features that people can get. There is this question. We haven't really seen any reaction whatsoever in the shares. Is this really such a big deal, or is this convenient for Apple that we're going to essentially get people rush to the stores to get theirs before the end of the year?
Well, I mean, yeah, that could well be the case, but let's, as you say, put this in a little bit of context. Apple, in its trailing 12-month revenue, is generated about $380 billion in revenue. The Apple Watch, the entire segment, generates an estimated $17 billion in revenue, so the whole segment is about 5% of total revenue. Go even further, how much of that is within the US? I don't know, 30, 40%. So all in all, it becomes a bit of a rounding error when it comes to Apple's overall numbers. Now, it's still kind of useful for Apple, not least, yes, clearly you make decent money from selling it, and for any other company it would be a sizable chunk of their income, but they also tie people to their iPhones. If you have an Apple Watch, you spent $300 to $500, you're probably not going to go and trade in your iPhone, which is necessary in order to keep the Apple Watch running. So it's a very good way of building stickiness, even if people don't refresh their Apple Watch as regularly as they might do a smartphone.
Do you have a sense of whether regulators have the backs of the likes of Apple just simply because of their place in the economy, or the opposite? There was some potential discussion about a reprieve from regulators.
Yeah, so the other possibility here is that the White House overrules the ITC and says, actually, no, Apple should still be able to sell them. They have done that in the past. A decade ago, there was a dispute over patents between Apple and Samsung. But of course, the difference in that instance is that Samsung is a South Korean company. Massimo, the company that Apple's in dispute with here, is an American company. So you'd be ruling in favor of one American firm over another one. That's a very tricky position for the government to be in. And therefore, a lot of observers seem to suggest that it would appear to be a less likely eventuality.
Not a great week for Apple. We talked about it yesterday, Alex. What's happening in China with the iPhone?
Yeah, it does seem as though that is a more significant headwind at this stage, that there's been a steeper crackdown on the use of Apple devices inside not only government agencies, but also state-owned companies. Formerly, it was the case in sort of 2 regions. Now that's been extended to 8, according to Bloomberg reporting. The challenge of that is not necessarily the direct sales to government employees and state-owned company employees, but what it says about attitudes towards Apple within the company. When this has happened in the past, we've seen a big chunk taken out of their sales in that part of the world. They lost about 20 billion in sales over the course of 4 years when there was a similar move to this. China has been a bright spot recently for Apple's growth. So if that were to be the fallout from this, it would be a far more considerable repercussion than what we're seeing with the watch.
Is competition increasing as well, Alex? We talked a lot about the Huawei Mate Pro something. Alex, how well is that particular phone, that product, doing?
It's quite hard to tell because, Huawei doesn't publish those numbers. We've seen estimates that say they're sold out. Well, we've seen reports that say they're sold out. We don't entirely know whether that's to do with demand or with a constraint on supply, because at the heart of this Huawei device is a chip that is supposed to be a lot more advanced than people thought possible for China to develop domestically. But that also might mean that they can only produce a limited number of them. Now, there is increased competition within China across the board, and that clearly creates a problem. But China, even with this more advanced Huawei device, remains a few years behind the bleeding edge of what's in the latest iPhones, about maybe 3-4 nanometers, which is 50% more powerful in very crude terms.
From what you hear when you talk to tech executives and analysts, do you get the sense that the feeling is thawing toward China and continuing to try to play in that sphere, or that people are just quietly accelerating the shift away from the country because of the inconsistency that they've seen in some of these policies?
I think the second part seems to be very much the direction of travel. You keep on hearing conversations about efforts to thaw relations with China, but then at the same time, policy goes seemingly in the opposite direction. You are still seeing an acceleration of production capacity outside China. Foxconn, which is one of Apple's biggest contract manufacturers, bringing more capacity to India. Foxconn itself investing in, for example, automotive manufacturing, which a lot of people are saying, well, suggests that they're not as optimistic about the smartphone market going forward. There's a lot of diversification going on right now, much of which is the fallout from those fears around China and how promising a market it will continue to be. Don't forget, the one massive caveat to all of this, Apple has an incredibly symbiotic relationship with China because it employs millions of people there, both directly and indirectly, to manufacture its devices. So China can't just cut them out of the market without doing a huge amount of damage to their own citizens.
Alex, appreciate the update. Thank you, sir. Alex Webb there of Bloomberg out of London. We'll try and catch up with Alex a little bit later. Don't want to start conspiracy theories, just saying it's highly convenient, maybe even a gift, that the International Trade Commission starts that ban on Christmas Day.
Yes, I would say that that's fair. I mean, we don't know. I mean, it's not necessarily.
It's a gift, just by definition.
It's a gift because people are going to go out and buy. As I was saying, you see the flashy things. Do you have an Apple Watch?
I do not, no.
Would you want something to read your blood pressure and your oxygen levels?
I've got one of them
in your sleep?
on my wrist, yeah.
Oh, really?
Yeah.
Okay, but you
I
just don't want
the
to have
screen
messages?
on it. No, I prefer a dress watch. That's just my preference. I don't like those big, chunky tech things on my wrist, and I don't want the distraction of the screen either.
Traditional.
I want to focus on the people at home and financial markets. That's what's important to me. That's too cheesy for you?
That was horrible. Please stop.
Sorry, I apologise. I take it back. I don't want to focus on you at all.
Exactly. You should
Chris
focus on
Heisey
your watch.
of Maryland Bank of America Private Bank is going to join us very shortly. Let's check in on the price action. Looking forward to that conversation. The bulls out in force over the last week and feeling very, very good about themselves. Jay Pilowski of TPW loving what he calls the external validation that he's been waiting for. The equity market leads are positive again this morning.
And it has been a bonds and stocks story. And this, to me, is the biggest question for next year. When do they diverge if we start to see weakness and the bond rally is supposedly negative for stock rally? It was supposed to be now. Not so much.
Chris Heisey coming up next on the equity market, very close to all-time highs, and then we'll catch up with Ellen Wald of the Atlantic Council on the Suez Canal grinding to a halt. From New York City, this is Bloomberg.
'23 was a year where, despite having concerns economically, we held our nose and we bought.
The wall of worry doesn't exist right now.
What we are definitely seeing is something that looks like post-pandemic normalization.
It has been an absolutely enormous rally here, and they're pricing in a tremendous amount of cuts.
If the Fed is successful in pulling off the soft landing, I would make the case that you get a little less, rate cuts.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. TK, I'm told, back with us tomorrow morning. Last show of the year altogether. Last show of the year altogether tomorrow.
I know, we'll have to celebrate the holidays.
Just before you get too excited about getting away for the holidays. A few more trading days still to go. Equity futures on the S&P 500 this morning, positive by 0.2% on the S&P. But Lisa, the train has left the station. And this Federal Reserve trying to pull it back, but it's gone, and it's not coming back.
And what we've heard from one investor after another is they have no reason to pull back because essentially the Fed put is back. And we laughed about this. Ben Laidler came on more than a month ago, and he said the Fed put is back. And we said, are you kidding me? That's ridiculous. And then one person after another, and then Fed Chair Jay Powell himself. They're concerned about jobs. And you know what? They're talking about rate cuts.
Chairman Powell, December 1st, different man to Chairman Powell last Wednesday. And the cleanup job we're seeing now sounds a little bit more like Chairman Powell on December 1st. But you can't forget what you heard on Wednesday. You can't put that to one side and say that didn't happen. And already implied in the dots, three cuts next year. Market's taking it further, I get all that. But you've got Doves on the FOMC now, Mary Daly of the San Francisco Fed saying 3? That's not accommodative at all. And the worry, this is the shift, and you've touched on it. It's the balance of risk. We're super worried about inflation. We need to cause pain to get inflation down, so be it. So be it. And now the turnaround we've seen in the last few months, we don't want to damage jobs to get inflation down, is essentially what we heard from Daly yesterday in the Wall Street Journal.
I have a lot of respect for Mary Daly, and I was reading her comments, and I thought that they were pretty transparent. The problem here is that the market is moving ahead of the Fed. And the problem here is that accommodative conditions in the financial markets can affect the chances of getting inflation down. So here is the question ultimately. Is this Fed more willing to allow inflation to remain higher for longer in order to preserve the labor market? Is that the new shift, the 2-point something that Rich Clarida had been talking about?
So this hour is set up perfectly for that with Richard Clarida, the former Fed Vice Chair, just around the corner. PIMCO's very best joining us in about 27 minutes' time. Theme of this morning already. Started at 6 a.m. Eastern Time. Jason Trennert, Strategas. He thinks there's a risk of a second wave of inflation off the back of the easing financial conditions we've seen in the last few months.
This is the reason why whenever I get a note from Andrew Hollenhorst at Citigroup, I always open it because he's been saying the same thing. People now pointing to the potential for some of the shipping routes being upended as having inflationary pressure. But the bottom line is this. Historically, there have always been these sort of echoes of inflation. And historically, you have seen when people start getting confident and they have higher incomes, they go out and they buy, and you could see prices pick back up again in a new way.
There's always something to worry about, isn't there? What's that song? Someone mentioned it earlier. Don't worry, be happy.
Yeah, Bobby McFerrin.
Don't worry, be happy.
Are you telling me that?
Don't worry, be happy.
It's in my blood. I mean, honestly,
course, yeah.
And honestly, the amazing thing is I'm seeing all these investors.
I know that song hits you deeply.
I
feel
would try
exactly
to
the same way. Sure.
Stop.
Here are the scores right now on the
Thank
S&P
you. 500.
We are just about positive by 0.2%. Your bond market set up as follows. Rallying still. Yields lower by 3 basis points. 390.14. The traffic in the Suez Canal grinding to a halt. We've seen warning after warning from Maersk, then BP, on going through the Red Sea. Looking at commodities, I would say pretty calm relative to the conversation is happening elsewhere. 72 on WTI, we're negative 0.4%. Brent, south of 80.
Kevin Book came on yesterday and was talking about how he's surprised there hasn't been more of a reaction in the commodity space. Why are people looking past this, considering that it's 12% of global trade? That's a good question. It's unclear, especially because Anne Marie just came on and said it's hard to see an easy resolution to this anytime soon.
Commodities are touched lower. We're down 0.3% on Brent crude this morning. Chris Heisey joins us now, Chief Investment Officer at Maryland Bank of America Private Bank. Chris, let's start here with the dream, the story for next year, if you will. This is the story. So inflation is going to keep coming down, growth is going to be okay, and the Federal Reserve is going to cut interest rates, and the equity market's going to keep on exploding higher. So that's the story. Can you tell us how expensive is that story now for next year, given the rally we've had in the last 2 months?
Well, it appears expensive because of how fast it's been priced in, but we have a long way to go. There's still a lot of cash on the sidelines, not just from an investor perspective, institutional and private client, but also the corporate cash, still earning a very healthy return at the short end of the curve. That's keeping margins wide. And with the debt structure in the corporate markets right now, overall, their liabilities are still low. So we can chunk out some very solid earnings here. And Lisa was talking about this echo of inflation. I think that's the perfect way to think about it. There are echoes. There's going to be a lot of echoes about, are we having a soft landing? There will be pockets of bumpiness, and that'll keep investors a little bit still concerned. Right now, the wall of worry, may be a little bit lower than normal, but that wall doesn't go away. That wall ends up rising a little bit as we get into next year.
There's like 5 bricks left in it, Chris. I'm not sure what you're talking about. What bears are left?
There's a lot of bears. They'll come out of the cupboard again and out of the cave as soon as you see one bad number, either on the earnings front, on the inflation front, or something like that. And that will actually cause some second guessing. But we think there's a lot of room to go here. We're not out of the woods, and we have a lot of work to do, but we're not fully priced in.
So, Chris, you're saying that the bears still exist. You're just not one of them after hearing from Jason Trennert, the Fed shot the bears, and from A.V. Sheffield, that Powell's press conference reminded us that the Fed's ultimate goal is not price stability and full employment, but rather to make people happy. So, in other words, how much can people remain bearish with a Fed that essentially has a big put and they're putting it in?
Well, I think the bears got very frustrated this past year, and rightfully so. They expected earnings to decline. They expected stickiness on inflation. The number one surprise for most people was that inflation came down as sharp as it already has. That really shouldn't have been a surprise when you had quantitative tightening plus all the hikes that went through. Now, granted, the Fed did add a lot of liquidity to the program, to the markets itself. That helped grease the train tracks. But overall, what we've noticed is this. The bears ultimately go away for a while. They come back after you start to see some of consternation in some of the economic data. Europe could surprise to the downside. We don't know what China's growth rate is going to be, and that could be exported to the United States. So we're still going to grow below trend, and everyone's happy right now, and the drumbeat of soft landing is there. But as soon as you get some bumpiness, the market will pull back a little bit, probably late January, early February, and we think that is a buying opportunity because it's all about earnings next year.
Chris, I got to say, I knew what you were going to say before you said it, because that's what everyone's saying. In January, we're going to get turbulence and buy the dip. And so at a certain point, this really is the exact same setup that we had this year, which was when you get a decline, buy the dip. We didn't really get a decline. We did a little bit, and people just came in gangbusters. Is this buy the dip going to be the broadening out that we see now? Is this basically the playbook for next year, just a little bit premature?
Yeah, so the bulls are beating the drum on the mega tech still. In some cases, that makes sense because that's the area of healthiest balance sheets, high quality. But the question is going to become how much can they surprise above the earnings expectations? But the broadening out of the market is the one area that some are now starting to warm up to. They've been left for dead. Much of the rest of the market, particularly small caps and value overall, we think the next story beginning already this past month, carrying into next year, for the next 5 years, the leadership are those areas, predominantly because of their underpriced movement versus the large quality, high quality area of the market, not just this past year, but over the past quite a few number of years. Last but not least, I'd say this, Lisa, those bears in terms of what they're looking at right now, they're looking at the what could be versus the what is. And ultimately, when that conclusion doesn't come through about what could be, stickiness or resumption of inflation, or much lower, maybe the negative leading economic indicators indicate lower growth, negative growth. That's what could be versus what is and what the data is telling us.
Chris, you mentioned the small caps. We've started to see that participation in the last few months. Small caps started to do well. The banks have absolutely ripped. There's one area of the stock market that hasn't participated. It's been left for dead. It's been the energy stocks. The energy names, as we've seen this rally play out, double-digit percentage point gains on the S&P 500. Energy's negative on the S&P, Chris. What's behind that, and what changes that story, if at all, into next year?
Yeah, Jonathan, and this is in the face of basically a year's worth of gains in a month and a half. If you really think about the broad market itself, small caps, the rest of the market outside the Magnificent Seven rallied over 12, 13% from the flatline level, and they've actually outperformed. But the one sector, as you said, energy, high free cash flow, actually better balance sheets than people think. I think there's a growth worry there for the energy sector. We've been overweight. The energy sector has not worked this year. We expect that angle in terms of investors looking for free cash flow again to start to come in. But it's all about the oil price right now. It's weakness in Europe. It's the below trend growth in the U.S. It's a lot of stories of a cloud hanging over what traditionally would be an area that you would hunt for, particularly when financials are working. You would think that some of the other areas like energy would. But right now it's pushed off the blotter. It's not on the buying blotter of a lot of the asset managers, and they're waiting for signs that oil prices are going to come back up again.
Chris, when you talk with your clients, how willing are they to actually deploy cash right now? How much are they feeling the holiday season of bullishness?
Just 2 months ago, it was all about what's around the corner to actually thwart any extra rally. Now it's all about, okay, where should I be as it relates to the market? Not significant enthusiasm because the geopolitical curve and volatility is still there, as you talked about before in the Red Sea. But ultimately, heading into next year, the common question is always, how should we be positioned? Now it's about how much and when should I be adding to areas of equities and longer duration fixed income. We talked about it in the summer. We talked about it again in the fall. No one throws up a flare gun. No one rings a bell when that's going to happen.
Yep.
There's always a surprise that comes in. That surprise came with the Fed pivot, particularly Powell. We expect a couple more surprises to the upside early next year.
The psychology of markets are just phenomenal. Chris Heisey. Chris, thank you, sir. Enjoy the Christmas break of Merrill Bank of America Private Bank. So rates get to 5. You don't want to buy 5 because you think we're going to get 6. Rates drop to 4. You want to buy 4 because you're worried it's going to 3. That's how financial markets work. The psychology of them all the time. It just never ceases to amaze me. Just every single time I just sit here, I'm just like, yeah, okay, here we go again.
Well, it's sort of, what do you say? It's the only place where when something goes on sale, you don't want to buy it.
Yeah.
But when it gets more expensive, you want to race into it. It is shocking. How do you follow the herd at a time where the herd has won as soon as they get going? And what it took to sort of, key off the herd was the shotgun from Fed Chair Jay Powell saying, let's go.
Well, the herd was already running.
Fair point.
Got to be clear about that, right? The herd was already running.
True,
He's like, keep going, keep going. 10-year, 390. If you're just joining us, welcome to the program. The S&P 500 positive here by 0.2%. Yield to lower by 3 basis points, 390.14. Allow me to frame the next 60 minutes on Bloomberg TV. You do not want to miss it. On the Suez Canal, on the Red Sea, and the traffic grinding to a halt, Ellen Wald of the Atlantic Council joining us very shortly. Then you're going to hear from Richard Clarida, the former Fed Vice Chairman and PIMCO Global Economic Advisor, in about 15 minutes' time. Then a little bit later, the Bank of America boss himself, Brian Moynihan. Don't miss that. And to top things off, as we anticipate the opening bell in about an hour and 17 minutes, we'll catch up with Mohammed Al-Arian to weigh in on what's been happening with the Fed speak of the last week.
It's an awesome lineup to give us a little bit more clarity. And I really would like honest talk about whether people are just as confused as we are about why there has been maybe a cleanup act among some some existing Fed officials at the same time that it seemed pretty clear what Fed Chair Jay Powell was doing and saying.
I just don't like the gaslighting. Just don't tell me I didn't hear what I heard on Wednesday. Okay? And it was very different to what I heard 12 days previously. Very, very different.
The shades of gray that you're trying to create around this, it was not gray.
No.
On Wednesday.
It was very black and white.
It was.
On Wednesday, without a doubt. Equities right now on the S&P positive by 0.2% from New York City. This is Bloomberg.
The Maritime Task Force, to the degree that it can provide security for tankers in the region, might not eliminate the risk premium, but it could potentially keep it from rising. The supply cushion that you get from spare capacity from OPEC producers is usually something else that can come to the rescue. But in this case, that supply cushion is less available. We may see more risk showing up in price perceptions as we go forward. But yeah, we've been sleeping through some very serious potential supply risks for some time.
We're wide awake now, so let's talk about it. Joining us right now from the Atlantic Council is Ellen Wald. Ellen, this is a big, big story. Traffic going through the Suez Canal, the Red Sea, grinding to a halt. Can you walk us through the additional time that's required if you can't go through there and you need to go around the southern tip of Africa? What are we talking about here?
Yeah, it seems that we're talking about an additional 12 to 14 days of travel time to go around Africa. But that's not the only issue here. We're also talking about increased fuel for ships, a longer trip for the crews on board. It's going to cost more. They're going to emit more carbon. And so this isn't just, it's not safe or the Suez Canal is closed. We've had that before. This is a very significant journey. And it's particularly important right now because it used to be that Europe was getting a lot of its oil from Russia. That's not happening now. And it's relying a lot more on oil from the Middle East. And so if that oil can't go through the Suez Canal, then now we're talking an extra 12 to 14 day trip around Africa. And it also cuts out the Sumed pipeline because that pipeline is accessible. Also, you have to go through the Red Sea to access that pipeline as well. So essentially only you can get Saudi oil if it leaves the west coast of Saudi Arabia, which isn't a place where that much oil leaves Saudi Arabia. That can get to the Suez Canal or the Sumed pipeline without threat of Houthi activity. But otherwise, everybody else is stuck.
So if this was 2021, this would be dreadful. 2022, chaos. We'd be talking about higher prices and inflation spiraling out of control. In 2023, it just feels like supply chains are in a better place. Ellen, can you describe them? Are we in a better place?
Yeah, we're definitely in a better place. We're not going to see oil shortages. We're not going to see gas lines. During the Suez Canal crisis in 1956, that's what we saw when the Suez Canal was closed. We also didn't have at that time the very large crude carrier, which were these massive crude oil carriers, which they basically invented in order to take crude oil around Africa so that they could get enough to Europe. So we've got that now. So we're not talking devastation, but we are talking about increased time at a time when we've already got increased time to get oil shipments to Europe, and we're talking about increased costs.
Are you surprised that we haven't seen more of a pop in oil prices as a result, Ellen?
I'm not that surprised because this is something that's been going on for a while, and it's only recently, I think, escalated to the point where tankers and shipping companies that are not directly connected with any kind of Israeli interests are getting concerned and are making moves. So I think that the market has kind of been anticipating this for a bit of time. And then you've also got these overall kind of economic issues waiting on the market. I think that maybe they should be more concerned, especially because the idea that suddenly the U.S. Defense Secretary is only now setting up a commission to deal with this, that doesn't bode well.
And there are questions around what that commission can actually do, what they are willing to do, and what exactly the conversations are between the U.S. and Riyadh, for example, which might have more influence over the Houthis than, say, Canada. So how much, from your perspective, do you think that the right people are involved in these conversations? And do you have a sense of what the potential allies in the region might be willing and able to do?
I think that Riyadh would love nothing more than a green light from the United States to just bomb the heck out of the Houthis in Yemen. I don't think they're going to get that. I think the real issue here is where the Houthis getting this technology and these drones to buzz these ships and cause these issues. And that's the answer to that is Iran. And when you look at the likelihood of maybe a U.S.-Iranian confrontation over this, that's not something I think the U.S. is willing to risk. So the question is really, what kind of show of force is the United States and potentially an international coalition? Because safe passage in the seas, essentially freedom of the seas, is an international issue. This is not just a U.S. issue or a U.S.-British issue. This is really an international issue that China should be concerned about, Korea, and we've got everyone should be much more concerned about this than they are. But the question is, who's going to actually put the muscle where it needs to be. And I'm not sure that we're seeing willingness to do that.
You touched on potential losers. I believe you mentioned European importers. Can we talk about winners? Who wins from this situation, Ellen?
Africa. I'm sure that South Africa is absolutely thrilled to see lots of increased traffic at its ports. In an extra, 12 to 14-day trip, sailors are going to want to stop. They're going to want to, have a break. They're going to want to go, on land. And so I think Africa is definitely a winner here because they're seeing a lot more traffic, and that means they can charge for it. I do think that Egypt is a huge loser here that really can't be overlooked, because if we're seeing a lot less traffic in the Suez Canal, they're losing money over this, and a lot of money.
And just to finish on prices, oil versus gas, is it a bigger issue for one versus the other, or the same?
I don't think so, because also when we talk about oil going through the Suez Canal, we often talk about it in terms of petroleum products overall. We're not really differentiating between crude oil and products here. So I think it's all tied in.
Ellen, thank you. Appreciate the update. One to watch, a developing story over the last week for sure. Ellen Wald there of the Atlantic Council, and lots of people weighing in. Lisa mentioned Andrew Honhorst, the city. I'll share that quote with you again. The effective closure of the Suez Canal trade route is a new upside risk to goods inflation. Lisa, just as you get comfortable with goods disinflation, this one happens.
The lack of clarity around just how much of an inflationary impulse, though, I think we're going to have to be parsing through for a while. You raised this good point. If it were in 2021, or even 2020 or 2022, it would have been much more challenging. But now that supply chains are up and running, maybe it's less disruptive. It doesn't feel like it's being priced in all that much, though. And Kevin Book was really adamant about that there could be more upside pressure on energy prices. But I do wonder if it's beyond that, if it is also goods, if it takes an extra 2 weeks to get something and it has higher insurance costs and there's the fuel cost and there's the labor cost. I don't think it's going to be the companies paying for it.
I won't use the T word. Okay, maybe I will use the T word.
Come on, go for it.
Transitory?
Yeah.
How transitory would an episode like this ultimately be? And is it something the central bankers even need to be focused on? Developments of the last week.
They never are until they are, right? This is the same thing with oil prices. Oil prices are transitory. They come and they go, but they influence people's sentiment. They influence exactly what the price of different goods are, the price of airline tickets, et cetera. So, at a certain point on the margins, if you get goods reinflation at the same time that services inflation is sticky, well, that's a bit more problematic.
Then we're not talking 6 rate cuts that are currently being discussed in financial markets, no?
I mean, that's part of the issue, that people are starting to talk about the reinflation kind of risk. But right now, I don't know. They're going to worry about that in January, not right now.
Here's your lineup for the next hour on Bloomberg TV. Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Monica Desena of JP Morgan. Matt Miskin of John Hancock. And we will catch up with Mr. John Stolfus himself, the biggest bull on Wall Street out of Oppenheimer, and why, Lisa, he's so bullish and everyone else is joining him after what we've seen in the last week.
To say he's the biggest bull right now doesn't really feel even fair, considering that he's almost consensus at this point. What's his call, 5,200?
Something like that, but not highly dependent on rate cuts, which is what makes it somewhat original. And it was up there above 5,000 before everyone else started to really join in. And he's been right this year. Let's be clear about that. He's been right this year, and he's looking for more of the same into next year.
And the fact that it's not because of rate cuts really speaks to this feeling that profits will continue to be robust. And we heard that, even people bullish, even with a recession at some point, a soft recession.
A soft recession? What is this? What is a nice recession? What is that? What does that even mean?
Basically, a little bit of negative growth, but it doesn't really feel that way. And the labor market kind of remains intact, and it's just kind of,
Doesn't feel that way for who? For markets?
But this is the issue. People are feeling it.
Exactly.
Individuals are feeling it. Small businesses are feeling it. And that, I think, is part of the dissonance between overall general composite data that shows good news and what people are feeling, which has consistently been less than that.
That's your lineup for the next hour. For the next 10 minutes, don't miss Lisa's conversation with the former Fed Vice Chair, Richard Clarida, and David Weston sitting down with the Bank of America boss, Brian Moynihan. All of that coming up in the next 60 minutes or so. Equity futures on the S&P 500 positive here by 0.2%. From New York City this morning, good morning.
Welcome back. This is Bloomberg Surveillance, about an hour to the opening bell with another lift to the markets after the longest winning streak to the S&P going back to 2017, reaching all-time highs on the NASDAQ 100. The S&P bumping up against them, up almost 0.25%. It's like deja vu all over again with yesterday morning at this exact same time, although this time we're above 4,800 on the S&P, 4,803. We're seeing yields lower, inflect lower yet again, 3.89% in the wake of a lot of discussion around the potential for rate cuts, and crude off just 0.25% after yesterday's pop on the heels of some of the disruption that we're hearing about with the Suez Canal and the Red Sea being disrupted, the shipping channels there. I do want to bring to you some breaking news. We are getting some economic data. Housing starts came in higher than expected. This, again, comes after mortgage rates came down. We're seeing that, and actually an inflection upward in home builder sentiment yesterday for the first time since August. 1.56 million housing starts. The expectation was for 1.36 million. That is up significantly from the prior month. And building permits coming in pretty much in line, 1.46 million. What you can see is, again, the sense of optimism as people look out ahead to the fact that we do have a constrained housing supply, and we are not seeing necessarily some of the existing homes come back on the market. Mortgage rates have fallen from north of 8% to about 7%, leading some people to feel a bit more optimistic about the pricing. Not seeing an incredible amount of reaction in markets, but again, just another node of positive data, even amid the disinflation. A little pop to your yields, but nothing significant as people look toward the inflationary data that comes later this week. This is a conversation that, to me, caps off one of the most fascinating periods of Fed history and economic history that I've ever seen. Rich Clarida, former Fed vice chair, as well as Columbia University professor and PIMCO global economic advisor, as well as renowned singer. Rich Clarida, thank you so much for being here.
Hey, Lisa.
In person. I just want to start with what you make of the past week, Fed Chair Powell's comments and the market's reaction.
Well, the chair's comments took me by surprise, and he had a difficult mission because it's the last meeting of the year. It's natural to look ahead, but yes, I thought both the press conference and the FOMC statement were more dovish than I expected. You know, there is a soft landing base case. We're all hoping for it. And I think the markets are really focused on that. He didn't say mission accomplished. I'm not sure if he thinks mission accomplished, but that's being interpreted that way. And of course, as you've mentioned on air, we've had a little bit of pushback recently. So we're all now trying to assess, you know, what message they would like to deliver.
Well, that's exactly what I wanted to ask you. What do you make of the pushback?
Well, I think the delicate challenge, and we've discussed this on the show in the past, is a tug of war between their guidance and market pricing. You know, part of the reason, Lisa, inflation is expected to come down next year to 2 point something is because financial conditions have tightened. Well, as the markets think mission accomplished and rate cuts, 6 cuts are coming in next year, that will ease conditions. That makes it less likely that inflation comes down. So it's a tricky point right now for the Fed.
Do you think that Fed Chair Powell made a mistake?
I don't think so. I think he was reflecting his committee, and I think in the press conference, sometimes chairs can sort of distance themselves, and I think he was embracing the baseline view. But there is a risk case as well, and I think perhaps some of the pushback is to remind folks about those other scenarios.
Mary Daly, in a Wall Street Journal discussion yesterday, came out and said even if the Fed cuts rates by 3 times next year, that the Fed's benchmark rate will still be quite restrictive, even if in that scenario. And then she wanted to say we have to be forward-looking and make sure that we don't give people price stability but take away jobs. Is this a new emphasis for the Fed?
Well, Lisa, I think at the margin it is, because I think inflation was so high for so long. I think the Fed effectively had a single mandate for a couple of years. We got to get inflation lower. The Fed, of course, has a dual mandate. But I do think, and I, of course, work closely with Mary, I'm a big fan of hers. I do think the issue is that the committee itself emphasizes financial conditions. Indeed, financial conditions made an appearance in the November statement and reappeared in December. It is true that one element is the real funds rate, but other financial conditions are easing, which, as we said, makes it less likely that inflation does come down.
Which raises this question about whether you were right. the 2-point-something kind of view of inflation is kind of what the Fed is embracing right now in order not to jeopardize the labor market. Is that what your sense is?
Well, I've always thought that 2-point-something would be the point at which they start to think about cutting. So that is playing out in their projection. I do believe down to the individual, there are 19 of them, they all want inflation to get to 2. And I do agree with them that if they hold off cutting rates at all until inflation gets to 2, they're probably going to overshoot. But the timing is delicate, and I think there is a risk case on both sides. But I do think they are emphasizing now the dual mandate more than they have been.
Do you think it's because they're seeing something that other people aren't, or they're at least emphasizing in their own data some of the weakness that maybe is overlooked by people who are piling into the market?
I'm not really sure of that. I think it's important for them, the Fed was criticized a lot in 2021 and 2022 for being behind the curve. I think it's appropriate to step back and acknowledge the progress in disinflation. And I think they're seeing that, but I think there's still a ways to go. And I think in particular, the labor market may require more adjustment than they're factoring in. Sorry.
No, it's all right. I'll let you catch your breath. It's a confusing moment for all of us. And I'm wondering if you think it helps or hurts the cause to see the Fed come out, Fed Chair Jay Powell with one message, and then Austin Goolsbee saying, you guys, I'm surprised by your reaction, and hearing from John Williams saying, we're not really talking about rate cuts.
That's not something you'd like to see coming out of a meeting. I think the market reaction, easing financial conditions, is something that they are trying to push back against. I don't know how successful they can be, however.
Do you think that easing in financial conditions does have ultimately an inflationary impact right now?
Well, to the same extent that if you tighten financial conditions, it lowers inflation. If they're eased on a sustainable basis, credit spreads are tight, borrowing costs are lower, valuations are up. At the margin, it supports demand. And if you think there's a demand piece to inflation, then yes.
So right now, do you think that it is potentially concerning and counter to what the Fed is looking for, given the all-in feeling? And frankly, I mean, we just heard this morning, the Fed shot the bears. The Fed wants to make people happy. I was bearish, but now I'm really bullish. I mean, is this a positive thing?
Well, I'm very convinced that the Powell Fed will do what it takes. I think that the communications challenges, which were substantial in 2023, may be even more substantial in 2024.
There's been speculation from a number of guests that there is a political element to this, that the calendar is tricky for the Federal Reserve, considering that heading into November, everything is going to be really politicized. Do you buy any of that argument that would encourage them to make a move earlier in the year?
Look, the history shows, in fact, I checked before I came on air, the Fed has actually adjusted rates in most presidential election years. In fact, they cut rates in 92 and cut rates in 08, although for other reasons, and they've hiked rates as well in election years. So historically, the Fed doesn't let the political calendar dictate the outcome. At the margin, could it influence timing, say, between a June move and a September move? I'm not sure. But I think that the number of rate adjustments we get next year will be the adjustments that the committee thinks is appropriate given the economy.
Given that we are talking about the politicization, do you think that this jeopardizes some of the credibility of the Fed, given that so many people have come on here and speculated? And we don't have any ability to basically know or not know. But is there some other consequence of just that speculation?
I really don't think so, Lisa. In the end, the Fed will be judged by returning to price stability and ideally doing so at minimal cost to the labor market. And so I think the Fed's credibility in the end will rise and fall with delivering price stability.
When you talk about the potential for a reacceleration of inflation and a stickiness, do you see that coming through the services sector in a material way? Which areas of the economy could we see a more material reignition?
Yeah, so I think I think exactly. So I think goods prices are now falling. So we've had goods disinflation, deflation. The service sector typically lags behind. I would also say I think where the rubber will hit the road, Lisa, is in the labor market. So we've had a substantial adjustment in the labor market without any rise in unemployment, and that is great. I will say my good friend and former colleague Chris Waller nailed that back in the summer of 2022. So that's wonderful. I do think, however, that you cannot have 2% price inflation target if wages are going up 4 or 5%, which is where we are now. So I think I would be, if I were there, I'd be looking at the labor market adjustment as well as the services sector as well. You know, one of the measures, which is core services ex housing, has basically not adjusted at all in the last several months, so still elevated.
A lot of people are talking about how the economic data has been really positive and how the Fed has been doing a good job and how we have seen unemployment stay low even with inflation coming down. Why do you think people feel so bad?
Well, I think there's a distinction, and it's certainly one I've thought about and written about. Economists tend to focus on inflation. That's the change in prices. But individuals in the economy tend to think about the level of prices. So even if inflation returns to 2%, the level of things, going to the grocery store, going to the movies, rent on your apartment, those numbers are all, a lot higher than they were 4 years ago. So I think when inflation's low and stable, we tend to ignore that. But when you've had a big move in the level of prices, I think it does create more concern among households than you may infer just by looking at the inflation data.
I want to ask you, though, also about the housing market. You mentioned rents being higher. We just got housing starts and building permits come in higher than expected. We do see some of the Treasury rally pare back, which is what you would expect. Does the high price of homes, in addition to the lack of any volumes, also create some sort of real dampening effect to sentiment?
Well, I think the high valuation for homes obviously makes the people who own homes happier, but there's a distributional consequence, especially for younger parts of the population, folks in their 20s and 30s who have not yet acquired that first home, and whatever they thought about the cost of ownership 3 or 4 years ago, it's a lot higher. But there's a huge wealth effect, positive wealth effect for folks who own homes. Presumably they're happy about that.
Well, but it raises this question about what this does longer term to the inflation dynamic, but also to sentiment, particularly for younger individuals who haven't gotten in.
Yeah, well, it does. And I think that this is an unusual period, Lisa, in the sense that because so many folks refinanced into low-rate mortgages in the prior decade, the Fed, including when I was there, was doing QE to support the mortgage market. And because these are 15 and 30-year fixed-rate mortgages, it is having this effect on supply that may be with us for a while.
We're here with Richard Clarida of PIMCO, formerly Fed Vice Chair. We are going to be having a conversation with my colleague David Weston, with Brian Moynihan of Bank of America. And I do want to get your take, Rich, on whether you are seeing the stability in banks as one reason why a soft landing can materialize, right? Is that sort of one tailwind that to a lot of this rally that was not there, say, in March?
Lisa, absolutely. You know, the global financial crisis triggered a major rethink of the way that we regulate and supervise banks in the U.S. as a whole. If you look at all the banks, they have lots of capital, lots of liquidity. And indeed, in 2020, when we were going through the dark days of the pandemic, you know, banks were a source of stability and increasing lending. So absolutely, I do think it's an important reason to think of the banking system as supporting the economy and not being a headwind.
Rich Clarida, thank you so much for taking the time, as always.
Thank you,
wonderful
Lisa.
to get your insights right now. If you are just joining the program, we do see a bit of a decline from earlier highs in the S&P futures, now up about less than 0.2% after better than expected housing data. Euro just a touch higher, 109.57. 10-year yields 3.91%. Right now, I am so pleased to say my colleague David Weston joined over with Bank of America Chair and CEO Brian Moynihan. David?
For our Bloomberg radio and television audiences worldwide, we are joined now by Brian Moynihan. He is Chair and CEO of Bank of America. Brian, thank you so much for joining us here at the end of the year.
David, it's great to have you here, and happy holidays. And you can see our teammates out there working away on the trading floor here at One Bryant Park.
Yeah, and we're going to go back to the trading floor because you had quite a year in trading. But first, talk about the year overall. There have been a fair number of surprises, given what some people expected at the beginning of the year. Certainly, the stock market has done very, very well. We had more interest rate hikes than we thought we would have. Unemployment has really held down pretty well. And we didn't have that recession so many people thought we would. Now, I must say, when I talked to you throughout the year, you kept saying the economy looks pretty strong. Some of your compatriots were saying, oh, no, hurricanes and tornadoes and things like that. So how'd you get it right?
Well, we just try to follow the data, and I think there were unexpected events. There are unexpected events in every year, and so whether it was the regional banking crisis early on in the year, or whether it was another, the Hamas attack on Israel on October 7th, whether it was escalation, a continuation in Ukraine, whether it's the tensions in China, these are all things that happen, and they go on all the time. But what we look at is what goes on in our core customer base, and we try to talk about what is going on as opposed to what could go on, and plan for what could go on. And that's been relatively strong. And our team, the spending continues even today at about 4 to 5% over last year, half the growth rate of 22 to 21, showing the consumer has slowed down, consistent with inflation getting under control, consistent with the Fed using the rate structure to choke off some of the activity, and it's happened. But overall, it's been a decent year, and the economy's grown, unemployment stayed low, and the bank's done very well.
Let's talk about the consumer. You are the largest consumer banking operation in the country. We are in the middle, toward the end now, the holiday season. What are you seeing there? I knew until now it was holding up pretty well. Where is it right now, the consumer, as of today?
Sure. So if you looked at it November of 23 over November of 22, and this is across about $300 or $400 billion a month of activity, customers spending money out of their accounts, that was up about 4.5%. So far in December, it's holding about the same. And again, that's about half the rate it was growing at last year at this time versus the year prior. And that's because the overall activity is slowing down. What's been interesting is it's broadened out to all things. There were these periodic things since the pandemic. First, people were holed up and bought stuff for their house. Then they started to go out and travel some. Then they went to restaurants. Then they had another set of travel, different kind of travel, international travel. And then they got to concerts and things. That's all through the system. And now you see it spending kind of evenly across, retail stores are doing fine. Online sales are strong. They're all up 2-3%, flattish, 2-4%, depending on what it is. So everything's kind of normalized for the U.S. consumer and how they're spending money. They are in very good shape. They have money in their accounts. They're employed, and the wages are growing. It doesn't mean inflation didn't affect certain parts of the American public hard, but in general, when the unemployment rate's still in the mid threes to mid upper threes, that is a very strong place for the consumer. But it has slowed down.
You say they're in good shape. That's what I was going to ask you. They're spending money. Can they afford it? What are you seeing in terms of their bank balances? I believe those have come down some. How fast are they coming down?
So it's a little bit of two different types of customers. For consumers that had a lot of excess cash, of course, when the rate they could get on that cash went from 25 basis points to 5% plus, guess what it did? It moved the market. So the very upper balances of consumer and our wealth management customers moved the market. But if you look at the consumers that the accounts are more the money coming in and out, they're still sitting with multiples of what they had pre-pandemic. So a cohort of consumers that had between $2,000 and $5,000 in their accounts pre-pandemic, average about $3,200, $3,400. They're now still sitting with about $13,000 in their accounts. It has come down from a peak of $13,400 down to about $12,800. So it's come down a bit, but still much higher than it was before. And that's due to all the stimulus and stuff, and them holding on to that. Where they go next is going to be a more interesting question. They've slowed down their spending because things got more expensive. They slowed down their spending because they got a little bit worried about their job. They slowed down their spending because the rates on car loans or all the things became more expensive. But they're still spending more than they did last year, and that's a decent setup for a soft landing.
Are you seeing any softness in consumer credit? I mean, are you seeing balances go up, delinquencies go up?
Well, balances have gone up on credit cards back to where they were pre-pandemic for us and the industry. And people are like, oh my gosh, and they're up above that even now. But if you adjust it for the size of the economy, they're actually still down. And so the consumer capacity to borrow is strong. Mortgages are all locked in at low rates. That the best asset for a lot of households is actually their low interest cost liability. It's mixing two different things on the balance sheet, but the reality is a 3% mortgage is an asset for people right now because it means their payments haven't moved. So that's good news. The home equity borrowings are down for us from $30 billion to $20-some billion. That means that they're not using that equity in their house, and there's more equity in their house. On the credit cards, the delinquencies are really consistent with the 19, and everybody says, well, it's back to 19. 19 was one of the best credit years in the company's history and the industry's credit history. So that's a very strong place. And so we feel good about consumer credit. And as long as the employment levels stay there, it's a little hard to believe that you'd have it. Now, lower FICO scores, you hear people talk about a little more noise, but the general consumer is basically a prime borrower, and they're doing fine.
What about the commercial side? You're very big in middle market, small and medium-sized enterprises. Is there loan demand? What's the sentiment there?
So, if you think about the consumer, we keep growing customers, keep growing households, keep growing this company. If you think about it in the commercial, we keep growing customers, more logos, as our teammates call it, companies that we do business with, a record number this year. The thing about it is they're not using our lines as much. So the loan balance growth on the commercial side has been a little bit sluggish, a little bit flattish. Looks like it'll bounce around in low single digits this quarter. Now, why is that happening? Line usage before the pandemic for middle market clients was 40%, dropped to 30%, got back up to 36%, and it fell a couple hundred basis points. Why would companies borrow less at this point? They're worried about final demand. It's also a lot more expensive. So the Fed is having the impact, which is a loan that was like 3% to 4% is now 7 to 8%. People think about using it. So the line usage is down, meaning that they're not being as aggressive buying equipment or hiring people or extending inventories, mostly because they're worried about the economy slowing down. And when we say a soft landing, it doesn't mean the economy goes into recession. It says no. But what our team is saying, Candace Browning, Platinum Research Team, is that we're slowing from almost a 4 to 5% growth rate to 1% growth rate is still a major slowdown, and the business community is wrestling with that right now, trying to get that balance right.
One of the big surprises this year came toward the end of the year with the Fed decision and then the news conference of Jay Powell that really signaled, at least to most of us, yeah, they're really seriously considering rate cuts. It looks like they're coming next year. Were you surprised, and why do you think they did it? Do you think they're seeing data about the economy that is slowing faster than we appreciate?
Yeah, so let's talk about what our economists tell me, and we feed in. We have the number one research team in the business, and Candace and the team do a great job. They just shifted yesterday, literally, and they moved to more rate cuts in 24. But the real key was, what do they see in the economy? And they basically have moved from a 0.5% growth rate annualized for the first 3 quarters of next year up above 1%. So they've softened their soft landing, let's just say that. And by doing that, they've said when the Fed is seeing inflation slow as fast as it is, they basically think we get down to the low 2s in inflation by the year and next year, 24, and it carries into 25. The Fed needs to bring the rate structure down. They're saying basically 200 basis points of rate cuts, 100 next year and 125, which still leaves you at 3.25, 3.5. Now, the last time we were fundamentally at that rate structure was it was 18 years ago by the time we get there. So we've had a long stretch of very low rates, except for what happened very recently. And so that fueled a lot of activity. And now the rate structure can be fundamentally higher. It's more structurally sound. And the Fed it's not really pivoted to say we got to normalize this because we're seeing the economy and the inflation come in. Not done yet, but all indications are doing there. And everything we can see that consumer spending is consistent with a 2% inflation economy. That level of spending growth in our customers was where it was in 17, 18, 19 when the Fed raised rates to bring the economy back in sync.
So the stock market did pretty well this year up until that Fed decision, and then it's off to the races since then. Your trading desk has done particularly well this year. To give us a sense of where it is right now, are you going to finish the year as strongly as you have been going this quarter so far?
Well, you can, from your lips to their ears, so they've got a few weeks left. No, they're doing fine. We said that they'd be up year over year, which is kind of counter to the trend in the market. Jimmy DeMar and the team have done a great job. And what's been interesting, it's rounded out, and it's fixed income, it's equities, and it's much more consistent. I'm not quite sure it's exactly true, but they basically made money every single trading day this year. And so there's been volatility, there's been news, there's been this, and that's because they have a balance in the business in the way that it goes through. We increased the size of the business 3 or 4 years ago under Tom Montag's leadership and Jimmy's leadership, and that's borne fruit. And they keep gaining market share, and they're doing a great job.
So I'm glad you raised that, because 3 or 4 years ago, I was here with you at Bank of America, and you said, you know what, you're going to have to devote more capital, more people into that business. You did it. You seem to be having success. Going forward, is there yet more capital that you're going to allocate into trading?
Yeah, as long as they can get the returns. At the end of the day, our return on equity is 15% as a company. This business, because all the regulations and the capital is a little lower than that, but it's well above our cost of capital. As long as they can keep deploying it, we'll keep pushing capital because it's a great business and great format, and we're gaining market share, honestly, across the world. And it's a global business, so it can access a much deeper client base. The team's done a great job, so they'll keep getting more commitments consistent with them being able to get the returns on them.
One last one, Brian. Are you concerned at all that the market's maybe overreacting to what they heard from Chair Powell?
I think he's got this challenge that, he was, the Fed in their own mission was late to cutting off inflation. Now he's going to be careful not to be late to stop cutting off inflation. And the market's going to ebb and flow. But I think people have to be a little careful. This is trading talk. This is, the 10-year moving around between, 390 and 450 and 470. It's not the real economy. The real economy is still heavily impacted by the overall rate level. It's very restrictive, and it's still coming through the system. Against that, we still have a lot of stimulus coming through the system. Yeah. The infrastructure bill, the CHIPS Act, the IRA, those are all still coming through the system. So that's a tug of war he's up against. But overall, we believe he's engineered a soft landing through the interest rate environment.
Brian, thank you so much. That's Brian Moynihan. He's chair and CEO of Bank of America. Back to you.
Thank you so much, David Weston. Wonderful work, as always, there with the CEO of Bank of America. Let's just get a quick look at markets that are fading just a bit after better than expected home building statistics coming in now just about 0.2%. Again, no drama. You can't dent this market when the Fed has shot the bears, according to Jason Trennert, and when the Fed wants to make people happy, according to Avery Sheffield. 48.03, looking at a bit of euro strength, even after some pretty negative numbers out of Germany with their business confidence, 109.61. 10-year yields still settling in about 2 basis points lower, 390. And looking at crude, really about flat, retracing some of the losses. A big question mark here about the attacks by Houthi militants on shipping containers as well as oil tankers going through the Suez Canal in the Red Sea. A question about what people will be willing to do, if anything, given the fact that the U.S. does not want to be involved in any kind of prolonged issue. What you are seeing across the board, though, is otherwise exuberance. 2-year yields also coming in dramatically since some of their near-term highs, just basically flat today, 4.44%. And in the credit space, we were just talking with Rich Clarida of PIMCO about the possibility of what rate cuts would look like and the stimulative nature of the rally that we've seen in markets. Right now, looking at investment-grade credit spreads about a percentage point over benchmark rates. Costs have come in. People are planning to borrow. Animal spirits revving back up. Is this a problem or is this warranted? Coming up on Bloomberg Television, Mohamed El-Arian, Bloomberg opinion columnist and Queen's College Cambridge president, in a conversation with Jonathan Ferro. You do not want to miss that. This is Bloomberg.